Okay, good evening everyone. Welcome to Baiju's Exam Prep IAS. This is Sham Kagur here. Now, before we start the discussion for the day, please let me know that I'm audible to you. Give me a thumbs up. Give me a thumbs up. Let me know that I'm audible to you so that we can start the discussion. Done. Let's start. So, as usual, before I start the discussion for the day, the beginning of the PPT, I've given you the articles from various newspapers which are related to what we have discussed in the classroom. And all of them are related to either banking, taxation, inflation, right, or fiscal policy of government of India, etc. Now, what is your duty? As usual, every week I've done my duty. Now your duty is to read these articles. Please read these articles. Let me know next week whether these articles are relevant to you, whether you have come across these in the newspapers, etc., etc. Done. So with that particular caveat, let me start the discussion for the day. Now, what we have done yesterday, we finished the concept of the fiscal policy. Correct? We finished with concept of fiscal policy, right? In fiscal policy, what we have discussed. Just a second. Just a second. Okay. Many of you are asking for the link of the articles. Okay. Just check now. There's a link. Please check. There is a link with my name. There is a link which has been posted. Right? You can download that particular PDF using this particular link. Now, some of you will be concerned about, sir, the lines are not clear, the words are not clear. Do not worry about all of it. Just magnify it. There is a concept called as a zoom in. There's a tool to zoom in. Zoom in, read, zoom out, go to the next article. Right? Don't worry about clarity of the articles, etc., etc. That is of no use for you. UPC will not be concerned whether right you have got the articles which were very clear HD definition or HD level clarity or less than HD level clarity. That is not required. Right? That is not required. Read what is given to you. Understand all those articles are relevant. Okay. Now, let me go forward. With that particular caveat, let me go forward. Yesterday, what we have discussed the fiscal policy, that is budgeting and finance are left out. Please don't panic. Today, we'll solve all the questions related to fiscal policy and the budgeting. That is budget as well as a finance commission. Now, next, after that, we started with the financial market. Correct? We started with financial market. Now, what is the concepts that we have discussed in the financial market? We started with the structure of financial market. In financial market, the instruments are traded, correct? Instruments are traded, and wherever instruments are traded, money will change hands. That is the concept of financial market. Financial market is divided into two parts. Is divided into two parts. One is money market. Second one is capital market. Now, what is the basic idea for money market and capital market? In money market, it will cover instruments which will have a short tenure. It will cover instruments of short tenure. Short tenure means what? Up to 1 year. For example, commercial papers, certificates of deposit, repo, reverse repo, etc. It will cover instruments which will have a short tenure, that is generally up to 1 year. And on the other side, capital market will cover the instruments which will have a medium term or long term. For example, bonds issued by right companies, bonds issued by the government, right, etc., etc. Now, based on this, let me ask you a very simple question. Let me ask you a very simple question. Please tell me the treasury bills of government of India. I repeat, treasury bills of government of India. Will it be part of money market or capital market? Based on the discussion that we have had yesterday, as well as even the revision that we have had today, the treasury bills of government of India, will it be part of money market or capital market? It has to be part of money market. Some of you saying capital market. Why? Please tell me, what is the feature of treasury bills? What is the important feature of treasury bills? Do you remember this? Treasury bills will have a maturity period of up to 1 year. Correct or not? It will have a maturity period of up to 1 year. Up to 1 year means 91 days, 182 days, 364 days. Now, any instrument which has a maturity period of up to 1 year, will it be part of capital or money market? Apply common sense, you'll understand it is part of the money market. Correct? Right? So, capital market more than 1 year. Instruments which are there in the capital market will have a tenure of more than 1 year. Now, capital market is further divided into two parts. Right? One is called as a debt market. Second one is called as an equity market. What is the basic difference between a debt market and equity market? Under both the markets, company will collect money. Company will raise a lot of money. But only difference is that in case of the debt market, the issuer of the debt instrument has to repay the amount back. Yes or not? In case of the term debt, debt means what? Liability. Debt simply means liability. You'll have to repay the money back. So basic argument is whenever you are issuing an instrument in the debt market, best example, bond, you'll have to repay the amount back. You'll have to pay the money back. And that is the precise reason this is called as a debt market. And in case of debt market, yesterday we have discussed a certain very important types of instruments. For example, we have discussed convertible bonds, non-convertible bonds, right? Indexed bonds, zero coupon bonds, correct? Convertible, non-convertible, indexed, zero coupon. These are the four types of bonds which we have covered in the debt market yesterday. Now we are supposed to cover certain other important types of bonds, in the debt market. After that, we'll shift to the concept of equity market. So with this particular revision, let me start the discussion now. Let me start the discussion. That is basically the types of bonds. Zero coupon is over, indexed is over, convertible is over, non-convertible is over. What are the other types of bonds? New types of bonds. Let's discuss. First one is called as a sovereign gold bond. Sovereign gold bond, in short, right? SGB, sovereign gold bond. Now, what is this concept of a sovereign gold bond? Point number one, India is a huge importer of gold. This is a fact, by the way. I'm not going to ask you. India is a huge importer of gold. Huge importer of gold. On annual basis, government of India, or let's say India, will import huge amount of gold, as a result of which, lot of money will go out of India. Lot of dollars will flow out of India. That's the point number two. Point number three. Point number three is whenever you purchase gold, whenever you go to the market and purchase gold, you'll be worried about the purity of the gold. Yes or no? Whenever you purchase gold, you will be concerned about purity of the gold, whether this is a 24 carat or not, 22 carat or not, or 18 carat or not. Right? The seller says it is 18 carat, but you are concerned about the purity of the gold. Third one is, if you purchase gold and keep it in your home, and you go to, let's say, Europe for a trip, you go to Australia for a trip, or you go to Ahmedabad to watch a match, you're worried about safety of your physical gold. Correct? You're worried about safety of your physical gold. That is, you have gone to a tour. What if someone will break into your home and steal away all your gold? So safety of the gold is also a concern for you. So understand this. Government of India says we import a lot of gold, as a result of which dollars will go out of India. Second, when you purchase gold, you're concerned about purity of the gold. Third, when you purchase gold and keep it in your home, and whether you're in office, whether you're out of station, out of India, etc., you'll be concerned about the safety or the security of the gold. Rather than doing all of this, rather than being concerned about all of it, why not, rather than purchasing physical gold, why not replace with an instrument called as sovereign gold bond? Rather than purchasing physical gold, why not simply replace that with a sovereign gold bond? Now, what is the meaning of a sovereign gold bond? Follow this very carefully. Let's imagine right now, for 10 gram of gold, the actual price is, let's say, 60,000 rupees. Whatever exact rate is there, please don't worry about it. For 10 gram of gold, 24 karat gold, the price is 60,000 rupees. Government says Rather than paying 60,000 and purchasing 10 gram of gold, purchase this bond. Purchase this bond and give me 60,000 rupees, and the price, the value of this bond will be connected to the price of gold. All of you okay with this? The price of this bond that you have purchased will be equal to whatever is the price of gold on that particular day. Meaning what? Imagine today you have purchased this sovereign gold bond. This is a sovereign gold bond. Today you have paid 60,000 rupees. That was equivalent to 10 grams of gold. The price of 10 grams of gold. Tomorrow the price will increase to, let's say, 62,000 rupees. For gold, price will increase to 62,000. Same way, the price, the value of the sovereign gold bond will also increase to 62,000 rupees. What if it will fall down to 57,000 rupees after 1 month? After 1 month, what if it falls down to 57,000 rupees? The price or the value of this particular sovereign gold bond will also fall down to 57,000 rupees. So all of you okay with this particular point? Anybody has a problem? Let me know. Anybody has a problem? It's a basic idea for connecting, indexing. You're linking the value of this instrument. You're connecting the value of this instrument to the market price of the gold. As the market price of the gold goes up, the price or the value of this sovereign gold bond will go up. As the price of the gold will fall down, the price or the value of this bond will also fall down. Now that is basically the concept of sovereign gold bond. Now what are the advantages? Why is the government of India promoting sovereign gold bond? Point number one, instead of purchasing physical gold, if you purchase a sovereign gold bond, don't you think automatically it means demand for physical gold will be lesser in India? Yes or no? Demand for the physical gold automatically will come down, right? It will be controlled. Rather than all of you purchasing physical gold, some of you will purchase gold bond. So rather than purchasing 10 grams, you'll purchase a bond, which means a demand for 10 grams. That particular 10-gram demand has gone down. Second point, if you purchase a sovereign gold bond, right? Many of you will talk about safety and security. Let me explain it. If you purchase sovereign gold bond, I'm showing you a physical document. I'm showing you a cardboard, by the way. I'm showing you a cardboard. But in reality, please understand, in India, we have introduced the concept of dematerialization. In India, we have introduced the concept of dematerialization. Now, many of you ask me, sir, what do you mean by dematerialization? All of you heard of demat accounts? Have you received calls from salespeople trying to sell you demat accounts? Have you received offers from your banks to open demat accounts, etc.? Even if you have not heard, no problem. You should have heard by it. You should have heard of it, at least now, right? You should have heard of it. But even then, don't worry. What is a demat account? Just like you have a bank account. You have a bank account. What will you keep in bank account? Money. Yes or no? Just like you have a bank account, you will keep money in your bank account. In the same way, the government has introduced, SEBI has introduced a demat account where whatever instruments you purchase, either shares or bonds, rather than you getting physical, rather than getting hard copy of the documents, you will receive the digital copies of these accounts. All of you okay with this? Rather than, for example, let's say you purchase this bond. Hypothetically, before 1996, if you purchase this bond, government would simply print a bond and send to you. All of you okay with this point? Before 1996, if you purchase this bond, government would print a bond, hard copy, and send it to you. But post 1996, we have stopped the printing of securities. We have stopped the printing of these instruments. We do not print hard copies. Whenever you purchase instruments, there is an account, demat account. In your demat account, instruments will be added. right? If you still have a doubt, at least tell me, all of you have used Paytm wallet? Let me know. All of you use Paytm wallet? And when you receive money in a Paytm wallet, do you think somebody will come hand over hard money to you? Do you think the owner of Paytm, Mr. Vijay Shankar, will come hand over 10,000 rupees cash into your hand and then go? No. Automatically, digitally, the money will be transferred. Apply the same logic. Apply the same logic. You purchase shares of Adani company. Suddenly, in your demat account, it will reflect saying that you have purchased the shares of Adani company. Numbers are so and so. So the argument is simple here. You do not have to be worried, right? What I'm trying to convey to you people, you do not have to be worried about safety of sovereign gold bonds. Can we go forward? You do not have to be worried about safety of sovereign gold bonds because these are in demat form. You will not be losing them. It's not in the form of a hard copy that you will lose them, somebody will steal, nothing of that sort. You do not have to be worried about safety. Now what about purity? What about purity? In case of physical gold, you are worried about purity. In case of sovereign gold bond, is there a concern over purity of sovereign gold bond? Absolutely no. Absolutely no. Right? Purity is never a concern in case of a sovereign gold bond because you are simply purchasing one instrument whose price is connected to the market price of gold. As the market prices will go up, sovereign gold prices will go up, and market prices will fall down, sovereign gold prices will also fall down. Fourth very important point, if you purchase a physical gold, if you purchase physical gold, will you get any interest rate on it? Let me know. If you purchase a physical gold, will you earn any interest rate on it? Absolutely no. You will not earn any rate of interest. But if you purchase a sovereign gold bond, government will give you 2.5% annual rate of interest. Government will give you 2.5 annual rate of interest. Now 2.5% of what? What was your initial investment? Whatever was your initial investment, on that amount annually 2.5% will be given to you. Correct? Right? So these are certain very important points. And sovereign gold bonds are nothing but G securities. These are issued by the government. Hence, G securities. These are the bonds which are issued by the government of India. Second, investor investment in case of sovereign gold bonds can be done instead of purchasing physical gold. How much can you invest? It will vary from one type of investor in the market to another type of investor, but the minimum amount of investment will be 1 gram of gold, right? 1 gram of gold, minimum amount of investment will be 1 gram of gold. For some of the investors it is up to 2 kgs, maximum up to 2 kgs. For some of them it is 4 kgs, etc, etc. Maximum will vary, minimum is 1 gram. Bonds will be sold through branches of nationalized banks, private sector banks, foreign banks, certain post offices, etc. The bonds will provide you annual rate, yearly rate of interest of 2.5%, 2.5%. But please understand, when I say these are bonds, they should have a maturity period. And what is the maturity period for sovereign gold bonds? 8 years. What is the maturity period for sovereign gold bonds? 8 years is the maturity period. Okay. And finally, many of you will keep on telling me, but sir, I can use physical gold to take a loan, etc., etc. Look at the last point. Please look at the last point. There are these securities are eligible to be used as collateral. That is, you can provide these securities, take a loan from the bank. These can be used as collaterals to borrow money, just like physical gold. Just like a physical gold, you will get loans on sovereign gold bond. A final point. Let's say you purchased a sovereign gold bond, and after 8 years, the bond will mature. Okay. Once you purchase sovereign gold bond, after 8 years, the bond will mature. In fact, you can sell it even before that. After 5 years, you can sell this particular sovereign gold bond. But let's say once they mature, on that day, I repeat, on that day, The day when the bonds will mature, on that day, whatever is the market price of the gold, you will be given the same market price. Is it okay? I'll repeat the statement. I'll repeat it. Imagine today you will purchase a 10 gram of sovereign gold bond. What is the market price today? 60,000. And after 8 years is over, whatever is the market price on the day of maturity, let's assume on the day of maturity, the gold price for 10 grams is 78,000 rupees, hypothetically. On the day of maturity, let's say gold price for 10 grams is 78,000. Government says, I will give you 78,000 rupees. You give me the sovereign gold bond back. Submit the SGB, I will give you 78,000 rupees. Government will not give you gold. Rather, government will give you the market price of the gold on the day of maturity. Done. So these are certain very important points regarding the concept of sovereign gold bond. Right? Sovereign gold bond, SGB. Can we go forward? 2.5% rate of interest, whatever is your initial investment. I repeat, whatever is your initial investment. Do you understand the term initial investment? Meaning at what price you purchased, that is your initial investment. On that, annually 2.5% rate of interest will be given. Okay. Next, green bonds. Next one is green bonds. Now, what is this concept of a green bond? Please look at the name first. Please look at the name. Right. So green bonds, right, by nature are those types of debt instruments where the issuer will collect money. Where the issuer will collect money, use this money only for investment in a project which is environment friendly. I'll repeat the statement. I'll repeat the statement. Green bonds are those instruments where the issuer will issue the instrument, collect the money, and use the money to invest in a project which is environment friendly project. Now, many of you will ask me, sir, what do you mean by environment friendly project? Can I give you a best example? What about solar energy project? What about wind energy project? Right, so environmental friendly projects. So money will be collected by issuing the bond, but this money will be used to invest only in the projects which are environment friendly. Hence these are called as green bonds. Point number 1. Point number 2, who can issue green bonds? Who can issue green bonds? Green bonds can be issued by the government. For example, Government of India last year has issued green bonds. Can be issued by government owned authorities also. For example, all of you will agree, National Highways Authority of India. National Highways Authority of India is a government owned entity. So National Highways Authority of India has issued green bonds. Private sector companies, any example of a private sector company which has issued a green bond? Ford company. All of you heard of company name Ford? Let me know. Ford company, a private sector company, has issued a green bond. Multilateral organization, World Bank. Best example is World Bank itself. So the private sector, the government owned entities, even multilateral organizations are allowed to issue green bonds. In case of India, please understand, in case of India, starting last year, Government of India has started issuing sovereign green bonds. It has started issuing sovereign green bonds. And whenever you come across a sovereign, what is the meaning of it? Issued by the government. Sovereign means issued by the government. Issued by the government. Sovereign means always government. Okay. Point number 2. The funds are issued. Sorry, the funds are raised. Funds are collected, and the funds will be reserved to be invested only in certain type of projects. What kind of projects? Let me give you certain examples. Renewable energy projects, clean transportation, sustainable water management projects, climate change adaptation, energy efficiency projects, sustainable waste management projects, biodiversity conservation, etc. So these are some of the projects, types of projects wherein the proceeds of the green bonds are allowed to be invested. Proceeds of the green bonds are allowed to be invested. Then that is point number 3. Now point number 4, listen to me very carefully. Green bonds, there is one concept associated with green bonds. There is a term called as greenium. There's a term called as greenium, right? What is this concept of greenium? It is a combination of two terms, green plus premium. There's a term called as a greenium, which is a green plus premium. Now understand the logic very carefully. Please listen to me carefully. Listen to me carefully. Let me ask you a very simple question. Imagine you will issue a bond at 100 rupees and you will give coupon of 6 rupees. I'll repeat the statement. Imagine you will issue a bond of 100 rupee and you will give a coupon of 6 rupees. Can I say coupon rate is 6%? Anybody has a problem? Coupon rate is 6%. Or else you can also say yield rate is 6%. All of you will agree with me? Yield rate on this is 6%. On the other side, what if you issue a bond at 120 rupees and you provide 6 rupee returns? I'll repeat the statement. You issue a bond at 120 rupees and you will give 6 rupee in returns to the bond investor. Can I say yield rate is 5% here? Anybody has a problem? Yield rate in the second example is 5%. Those will start asking me, how come 5%? Take the calculator, 6 divided by 120 into 100. Please calculate and tell me. Calculate and tell me, it will be 5%. Your C set is very vague, right? Couple of students are asking me, how come it is 5%? 6 divided by 120 into 100. Do it and let me know. Now, what is the concept here? Please understand what is the concept. Okay. A bond whose price is 100 rupee, I repeat, a bond whose price is 100 rupee will be issued at 120 rupee premium. Understand this very carefully. Let's say a bond is there, green bond, price is 100 rupee. Rather than selling the bond to you at 100 rupee, they will sell it to you at 120 rupees. Can I call this as a premium price? Yes or no? If the value of the bond, let's say this is the value, don't worry about anything else. This is the value of the bond, 100 rupee. I will not sell it to you at 100. I will sell it to you at 120 rupees. Can I call this as a premium? All of you okay? Selling this bond at a premium. Okay, remember this. Why you will understand in a minute. Please listen carefully. I will sell this particular bond to you at 120 and I will give you 6 rupee interest. I'll give you 6 rupee coupon. Now, can I say because I've issued at 120 and I'm giving you 6 rupees interest or coupon, the interest burden on me is 5%, not 6%. Yes or no? I'll repeat it again. The value of the price is 100. I'm sorry, value of the bond is 100. I will not sell it at 100 to you. I will sell it at 120 rupees to you. That is at a premium price. And I'll give you 6 rupees. Which means the interest burden on me actually is not 6%. Rather, it is only 5%. This is called as a greenium. Remember this. This is called as a greenium. Green bond premium. Green bonds are always sold at a premium. And what is the benefit? What is the benefit of selling the bond at a premium for the issuer? When they sell it at a premium, interest burden on the company, that is the issuer, will be lower. Yes or not? Interest burden on the issuer would be lower. Right? So that is the concept of a green premium. Now many of you are asking why? Why they will issue it at 120 rupees? You tell me, if somebody is implementing a project which is environment friendly, Should you collect more returns from them, or you should provide capital to them at lower rate of interest? Very simple question to all of you. If somebody is implementing projects which are environmentally very good, which are going to provide benefit to the whole earth, should you provide them with capital, or should you give them loan at a higher rate of interest or lower rate of interest? What makes sense to you? Right? Don't you think we should put lower interest rate burden on them? Correct? We should put a lower interest rate burden on them. So how can we ensure that interest rate or the burden on the issuer is lower? One way is basically reduce the rate of interest, or second way is purchase the instrument at a premium price. Purchase the instrument at a premium price, which means when the issuer will give me 6 rupees, right, effective interest rate on the issuer will be 5%, not 6%. All of you okay with this? Yes or no? That is, if you're still confused, if I give you 100 and you give me 6 rupees interest, the interest rate burden on you is 6%. Correct? Let's start with an example. If I give you 100 and you give me 6 rupees, interest rate burden on you is 6%. But rather than that, you will give me a bond whose price is 100, value is 100, but I will give you 120 rupees. And you will give me annually 6 rupees, or next year you will give me 6 rupees interest, which means burden on you is not 6%, rather it is 5%. Right? That is the reason green bonds are issued at premium. This is called as a greenium. Is it okay? This is a concept of greenium. Please remember, it is there in the current affairs. Suddenly UPSC can ask you that. UPSC can ask you this. Please be very, very careful. Okay, right? So these are certain points regarding the concept of green bonds. And many of you ask me, sir, will anybody invest in green bonds, etc., etc.? Trust me when I say this. In recent times, there is a lot of investors who are purchasing green bonds. And this is not a very old type of a bond. Green bonds are very, very new types of bonds. Only post 2007, we have started issuing green bonds around the world. Only in the last 15 to 18 years, we have started issuing green bonds. Right? So this is a very, very new type of a bond. And don't you think in the last 1 decade, especially in the last 1 decade, there has been a lot of focus on sustainable growth? Yes or no? There has been a lot of interest in sustainable growth. That is, we will have to achieve growth, but not abusing the resources, not by abusing the resources, by preserving the resources for the future generation. That is a basic idea for sustainable growth. Even government of India is promoting lot of reforms which will protect environment in India, which will protect environment in India. Right? For example, 2070 we want to become a zero emission country. By 2030 we want to make railways a zero emission country. We are promoting electric vehicles. We are promoting solar energy. We are promoting wind energy, right? Or International Solar Alliance. What are we doing with all of this? Sustainable growth. Ultimately, the target is protect your environment. So in the last 1 decade, there has been renewed focus on promoting growth, but not by abusing the resources, but by preserving the resources. And that is where the importance of green bonds will be there. Right? So that is the reason. In fact, remember this, there are types of investors in the market very famously referred to as ESG investors. ESG investors. ESG basically stands for environment, social, and governance. ESG stands for environment, social, and governance. Right? There are investors who are referred to as ESG investors. There are investments called as a ESG investments. Right? Because E stands for environmental. Lot of these investors will purchase green bonds. Lot of these investments will go into green bonds only. Done? Right? So that is the importance of the concept of a green bond. Please be very careful. Very new type of a bond, but multiple times mentioned in the current affairs. Multiple times mentioned in the current affairs. Now come to the next type of a bond, masala bond. Next type of a bond, masala bond. Now, first point, imagine you're an insurer, okay? You're a company. You will go to USA, issue a bond, and collect $100, or let's say not $100, let's say $1, not even $100, $1. You will go to USA and you will issue a bond and collect $1, borrow $1 from USA. Now, after 1 year or after 3 years, you're supposed to repay the amount. When you borrowed the money, it was $1 is equal to 50 rupees. Exchange rate was $1 is equal to 50 rupees. After 3 years, when you're supposed to repay it, it has become $1 is equal to 70 rupees. Please tell the answer to my question now. Is it affecting your returns or not? Is it affecting the money that you are supposed to repay or not? Are you not paying back more rupees compared to what rupees you have borrowed? I'm not even talking about interest here. Please understand. I'm not even talking about interest. You'll have to pay interest. That's a different thing. You have taken, in essence, it simply means you have taken 50 rupees, but now you are paying 70 rupees. Forget about interest, right? In addition to the interest. So I hope you understand the exchange rate. Exchange rate will have a huge impact whenever you have borrowed outside India in a foreign currency. Is it okay? Whenever you have borrowed outside India in a foreign currency, exchange rate will have a huge impact on how many rupees you are supposed to repay back. It is exchange rate risk. You're facing exchange rate risk. But what if I say, this is very interesting. Please listen to me carefully now. What if I say you go to USA and in USA, you will borrow in terms of rupees. Understand my point very carefully. What if I say you go to USA market, I'll take this, right? Simple, I'll take this. You'll go to USA, issue this bond in the USA. Please tell me the value of the bond is given in terms of rupees or dollars. Look at this and tell me, is the value of the bond given in rupees or dollars? In rupees. Can I say the bond is denominated in rupees? Can I say the bond is denominated in rupees? So you will go to USA, you will issue this bond, collect the money in terms of rupees. And upon maturity period, you will repay in rupee terms. How you will do that? Don't worry, I'll explain that. Just follow the discussion. Let's go point by point. You will issue this bond, you will collect the money in rupees, and you will repay the money in rupees. Now, please tell me, if you do this, will you face exchange rate risk? If you do this, that is borrow in rupees, repay in rupees, will you face any kind of exchange rate risk? Absolutely no. You are not going to face any kind of exchange rate risk. Why? You have borrowed 100 rupee, you will repay 100 rupee. You're borrowing in rupees and you are repaying in rupees. So where is the question of exchange rate risk? Right? What is worth $1? You are not worried about it. You have taken 100, you are repaying 100. So no exchange rate risk to you. Now listen to me very carefully. These types of instruments, I repeat, these types of debt instruments which we are issuing outside India, to borrow in rupees and repay in rupees, these are called as masala bonds. Is the definition okay with all of you? I'll repeat it again. These types of debt instruments which we are issuing, we means it can be done by a company, it can be done by even international agencies. For example, World Bank also does it, right? Many of you ask me, sir, why does World Bank do this? Please tell me, World Bank will invest in India? Yes or no? World Bank will invest in India. For that, they will require rupees. For that purpose, they will do it, right? And they don't want to face any kind of exchange rate risk. So I hope you understand. Companies, multilateral organizations, etc., they will issue the instruments outside India, borrow in rupees and repay in rupees. This is called as masala bond. In a nutshell, this is called as a masala bond. And what is the advantage of having a masala bond? Advantage of a masala bond is that the issuer does not face any kind of exchange rate risk. The issuer does not face any kind of exchange rate risk. Rather, the investor will face exchange rate risk. Now, please think of it. Why will the investor purchase such bonds? The investor will purchase such bonds because the interest rate offered, coupon rate offered is very high. Is it okay? The interest rate offered or the coupon rate offered will be higher. For example, you will go to USA and in USA you will issue a masala bond with coupon rate of 9%. You will issue a masala bond with a coupon rate of 9%. So don't you think that particular 9% is a very, very high rate of interest in a country such as USA? You will go to European market. You will issue masala bonds with a coupon rate of 7.5%. In an economy where interest rates are 2%, 3%, you are offering 7%. You are offering 8%. You are offering 9%. Because please understand, you want to make the bonds attractive. You want to attract investors in a foreign market. Can we go forward now? Can we go forward? This is the basic idea of a masala bond. Now, please understand, they will use the term offshore here. In case of masala bonds, they will use the term offshore. Offshore means what? Anything that has been done outside India. I repeat, for us, anything that is done outside India will refer to this as offshore. And anything that we do in India will call this as onshore. That is one more point. What we do in India will call this as onshore, and what we do outside India, it is called as offshore. That is one more important point. Third very important point, can I say these particular bonds, masala bonds, are issued in offshore market and we will borrow from an offshore market. And because we are issuing and borrowing outside India, please remember the masala bonds are a part of external commercial borrowings. Masala bonds are a part of external commercial borrowings. ECB. We'll discuss what is ECB in some time. Please don't worry. We'll discuss it. There is a concept called as external commercial borrowing. What do you mean by external commercial borrowing? Whenever Indian companies, Indian organizations, etc., when they will borrow from outside India, it is collectively called as external commercial borrowing. For example, you can go to a bank, take a loan from a bank in USA, or you can go to a market of USA, issue bonds in USA. Can I say whether you have taken loan from a USA bank in USA or you have issued bond and borrowed from USA market, it is basically external commercial borrowing. Yes or no? Please participate. It is basically external commercial borrowing. And one of the types of external commercial borrowing is masala bond. One of the types of external commercial borrowing is a masala bond. Okay, which means you can borrow either in your domestic currency or in a foreign currency, doesn't matter, but you're borrowing this from outside India. You're borrowing this amount not from within India, you're borrowing this from outside India. Hence, this is called as external commercial borrowing. One type of external commercial borrowing is masala bond. Bonds are issued in the overseas market. These are issued and are repaid in rupees. These are issued and repaid in rupees. Always remember this, right? Which means the investor will convert the dollar to rupee and give you rupees. The investor will convert the dollar to rupees and give you rupees. Right? So exchange rate risk burden, I repeat, exchange rate risk burden is borne by the investor, not by the issuer. Exchange rate risk in this is there, but not the issuer. Issuer will not take the exchange rate risk. The investor will take the exchange rate risk. RBI mandates that original maturity period If you're borrowing up to 50 million, should be 3 years. And if you're borrowing more than 50 million through masala bonds, should be 5 years. Should be 5 years. Now, final point regarding masala bonds. Why these are called as masala bonds? Why the name masala bonds? Now, please go back to your high school. High school. If modern India is over, good. Otherwise, don't worry. Go back to your high school. During the British time, right? During the 1700s, 1600s, is it okay if I say the term masala was connected to India? Yes or no? Right? During the 1600s, 1700s, the term masala, spices, and many of you will say masala means what now? Spices. The term spices was connected to India. So that is the reason if there is a bond in any other market where the value of the bond is given in rupees, we will simply call this as masala bonds. Right? If the value of the bond, denomination of the bond is given in rupees in USA or in UK, etc., we'll call them by default as masala bonds. Now let me ask you a couple of questions here. You tell me in which currency the bonds will be denominated. For example, please tell me samurai bonds. If you come across a term samurai bonds, in which currency samurai bonds will be denominated? In which currency I'm talking about? In which currency samurai bonds will be denominated? It will be denominated in yen. Yen. Some of you are saying yuan. No, my dear. Yuan is of China. Yuan is a Chinese currency. Yen is a Japanese currency. Samurai is a Japanese port. So by nature, if you come across the term samurai bond, the bonds have to be denominated in Japanese yen. What about baklava bonds? What about baklava bonds? What if you come across the term baklava bonds? Have you heard of baklava sweets now? Very, very famous in India. Very recently, these sweets have become very, very famous. Baklava is a sweet delicacy from Turkey. Baklava is a sweet, right? Just like sweets that we eat in India, desserts. They have baklava sweets in Turkey, and their currency is lira. Turkish lira. Lira is their currency. Okay, my dear, even lira was very recently there in the newspaper. Why? Check what has happened to inflation rate of Turkey in the last 1 year. Check what has happened to Turkish inflation rate in the last 1 year. That's the reason I'm saying even lira was there in the newspaper in the last couple of months. Okay, what about dim sum bonds? What about dim sum bonds? If you come across the term dim sum is nothing but momos. Dim sum is nothing but momos, right? That is yuan. Dim sum is momos, that is yuan. So all of you okay with this? Why the bonds have been named as masala bond? Why dim sum bond? Why samurai bond? Why baklava bond? Argument behind this is whenever the bonds are issued, the name will be given to represent a country. Right? To represent a country. Automatically looking at the name, you will realize that, okay, this is denominated in this currency. Recall value is very good for this. That is the precise reason. That is the precise reason, right? These kind of names are provided. Done. So these are certain new types of bonds. Please be very, very careful. Now, in addition to this, right, also remember the tier 2 bonds as well as additional tier 1 bonds. Correct? Additional tier 1 bonds as well as tier 2 bonds. So here itself, please understand, right? Here itself, we have discussed 5 new types of bonds. 5 new types of bonds, not normal, new types of bonds. Additional tier 1 bonds, tier 2 bonds, right? The masala bonds, the sovereign gold bonds, etc. So 5 new types of bonds we have discussed. Please be very careful. Question can be asked from any of these. Okay, now let me go to the next one. This is the end of the debt market. Let me enter into equity market. Let me go to the equity market now. Concept of equity market. Now, what is the equity market? If you remember yesterday, I said in equity market, the shares are sold. In equity market, the shares are sold. The shares of the company are issued, right? And you will purchase the shares. You can sell the shares. You can purchase it from somebody else. It is called as an equity market. The best example of an equity market, please tell me, if you're reading newspapers every day, do you come across a BSE and NSE in the newspaper? Yes or no? Do you come across BSE and NSE? Please don't tell me that you have not come across BSE and NSE. Don't tell me that. Why? If somebody says, sir, what is BSE, what is NSE, I've never heard of it, then my dear, please read. Please read newspapers at least. Every day there will be a mention of BSE as well as NSE. For example, in the last 1 week, or let's say around 10 days, is the Bombay Stock Exchange experiencing volatility because of Israel-Gaza conflict? Yes or no? In the last 10 days, is BSE experiencing volatility? Volatility means, right, day after day, BSE number will keep on falling down. Sensex number will keep on falling down, right? And the reason they will keep on citing is the Israel-Gaza conflict, right? So it is there every day in the newspaper. It is there, right? So please read the newspapers then. Okay, come back to this. BSE and NSE is an example where the equity, right? Equity is purchased, the equity is sold. For example, you can sell Adani shares in the stock market. You can purchase Infosys shares in the stock market. You can purchase Paytm shares in the stock market, right? So argument is simple. Equity represents shares. Shares can be purchased, shares can be sold, right? That is reason why this is called as an equity market. Now, before I discuss the concept of an IPO and FPO, right, there are two types of shares. There are multiple types, but don't worry. For UPSC, just remember two types. I'll come back to this. Don't worry. I'll come back to this slide. Whenever you talk of shares, shares represents units of ownership. Shares represent unit of ownership. And if you purchase a certain units, right, basically it represents how much is your ownership in the company. How much is your ownership in the company? Now there is one more term called as equity, right? Equity basically represents a percentage of ownership. Equity represents a percentage of ownership. For example, listen to me very carefully. Once you understand, it's very easy, but just to make you understand the differences. Imagine there are 500 shares issued by the company, 500 shares issued by the company, and let's say you will purchase 100 shares out of it. You will purchase 100 shares. Now, can I simply say shares represent individual units of ownership in a company? Look at the example and do let me know. Shares represent individual units in the ownership of a company. Now, how do I write equity? How do I represent equity? What is the percentage ownership you have in this company? You tell me. What is the percentage ownership that you have in this company? You tell me. Is it okay? I'll write it directly 20%. Correct? 20%. I will call this 20% as your stake or as your equity. Is the logic okay now? I will call this 20% as your stake or as your equity. I'll give you a current affairs example so that you understand it. All of you have come across in the last couple of months the newspaper articles where Adani company purchased majority ownership in NDTV. Right? I'll not talk about political aspect of it. I'll only talk about economic aspect of it. Adani company purchased a majority ownership in NDTV company. Yes or no? Right? What is the argument of majority ownership? The Adani company purchased more than 51%. More than 51%. Majority means 51%. So Adani company purchased more than 51% of ownership in the NDTV. Can I call this more than 51% as equity ownership or stake of Adani company in the NDTV? Yes or no? Equity ownership or stake of Adani company in the NDTV. How many shares were purchased? It is in terms of lakhs and crores. The number of shares, it is in terms of lakhs and crores. You don't have to be worried about it. But the percentage representation is called as equity. It is easier to talk in terms of equity rather than always counting the number of shares. So that is a basic difference. That's a basic difference. Okay. Share and equity. Same example. One more example I've given here. Now, whenever you talk about shares, there are two types of shares. Okay. There are two types of shares. One is called as an equity share. One is called as an equity share. Second one is called as a preference share. One is equity. Second one is called as a preference share. Now, before going forward, let me ask you a very simple question. When you say Adani company has purchased more than 51% ownership in NDTV, can I say the decision making power is with Adani company in NDTV now? Yes or no? Just think logically. If Adani company will purchase more than 51% ownership in NDTV, majority ownership, what is the importance of it? Importance is the owners, the shareholder, the owner can take decisions in the company. That is the importance. That is the importance of shareholding. For example, if you are having shares of any company, check it. If you're having shares of any company, in the annual general meeting, they will ask you to vote. They will ask you to vote. You might have not done it. You might have not checked even your email, right? Where they will generally send these, right? The voting, the information as such. So argument is simple. Whenever you have shares, you represent ownership, and because you have ownership in decision making, your votes are counted. Your votes are important there. Okay. Now, what is the idea of equity share? What is the idea of a preference share? What is the idea of equity? What is the idea of a preference? Equity, these are referred to as, the shareholders are referred to as equity owners or equity holders. These are referred to as equity owners or equity holders. Point number two, the amount of dividend that is given. The amount of dividend that is given, there is no guarantee how much dividend will be given to the equity shareholders. And by the way, please tell me, do you remember the concept of dividend? What is a dividend? From the profit, how much money will be given to the shareholders? It is called as a dividend. Yes or no? From the profit, how much money is given to the owners or shareholders? That is called as dividend. So if you're an equity holder or equity shareholder, from 1 year to next year, the amount of dividend that is given to you might vary. Amount of dividend that is given to you might vary. In 1 year, you might get 3 rupees. Another year, you might get 5 rupees. Third year, you might get 1 rupee. The dividend will keep on varying. Please remember that. Right? But more importantly, equity shareholders will have a voting right. In the decision making process, their votes are counted. Their votes are important. Now, some of will basically say, sir, I have, right? Some of will have this kind of argument. You are telling me that equity holder will have voting right. I have certain shares of a company X. Okay, I have shares of company X. I have 2 shares, but nobody is asking me for voting. Right? Nobody is asking me to vote. Nobody is asking me to vote. Nobody is sending me any information, etc. Two very important points here. Two very important points. First one, whenever there is an annual general meeting, trust me and check your email, you'll get the information. Whenever there's an annual general meeting, they will ask you to vote. They will ask you to vote. You can go to the annual general meeting, vote there only, or else you can go for absentee voting. You can go for absentee voting also. Second, day-to-day activity. Day-to-day activity. Imagine this: in the same company X, if I'm the owner, if I'm already the owner, and if I own, let's say, 56% of the voting right. I'm sorry, if I already own 56% of the shares, do I need your approval? Think of it. Do I need your approval for taking decisions? You might simply say, right, I will not approve it, I will oppose it, etc., etc. Even then, I will not require your approval. Why? Look at the percentage ownership with me. Please look at the percentage ownership with me, right? My ownership is more than 51%. I have majority ownership with me only. Why do I need your approval? So I hope you understand the logic, right? In annual general meeting, they will ask you to vote. They will send a mail also. Couple of you are actually checking and saying, yes, sir, I got a mail. I did not reply to that, etc. Good. Participate, reply to that, go for absentee voting. Right. Otherwise, and simply come to a conclusion, no use. I'll only look at the dividend, be happy with the dividend. So this is a concept of equity share. Can I go forward now? This is a basic idea for equity share. What about preference shares? What are preference shares? Please understand, preference shares will have features of both equity as well as bond. It will have both the features of equity as well as bond instrument. What is the bond instrument feature here? Right? Let me bring back your friend. Please tell me, if you purchase this bond, can I say annually you'll get 6 rupee? Yes or no? If you purchase this bond annually, you'll get 6 rupee. Right? This is a bond, by the way. Now, imagine you will purchase a preference share of a company. Okay, imagine you will purchase a preference share of a company. Company will tell you annually out of profit, annually, they will give you 4 rupees. Let me know. Is it a feature which is associated bond with bond? Correct or not? Is it not a feature that is a fixed amount of interest, a fixed amount of dividend if it is given to you? Is it not just like earning a fixed amount of interest rate on a bond? So that is the feature. It's a mixture. It is basically mixture. On the other side, if you have equity, you are a shareholder. You are a shareholder, right? You are a shareholder of a company. You will earn a dividend, right? That is, dividend will be given to you only when the profit is made. Only when the company earns profit, dividend will be given to you. So I hope you understand. In case of preference share, fixed amount of dividend is there, right? You are a shareholder. That is the reason I'll say the preference shares will carry certain features. It is a hybrid of both equity as well as the debt instrument. Correct? It is a hybrid instrument. Hybrid means mixture. It is a hybrid instrument of both the debt as well as equity shares. Right? That is the meaning of hybrid instruments. It will carry a fixed amount of dividend. These are preferred or equity shares in dividend distribution. That is, first preference is always given to preference shareholders. First preference is always given to preference shareholders, and after that, whatever dividend amount is left out, it is distributed amongst equity shareholders. But please understand, because you are getting a fixed amount of the dividend here, because you are getting a fixed amount of a dividend, there will be no voting right given to you. There will be no voting right given to a preference shareholder. Then can we go forward? Can we go forward? Right. So one is equity shares. Second one is preference shares. Right. Equity means you're a shareholder. You will have a voting right, and you will get certain amount of a dividend if the company earns profit. How much? No guarantee. It will vary from 1 year to next year. On the other side, if you're a preference shareholder, you are an equity holder. I'm sorry, you are a shareholder. No doubt, you are a shareholder. You will get dividend. In fact, you will get fixed amount of dividend annually. Annually, you will get fixed amount of dividend from the company's profits. From the company's profits, a fixed amount of dividend will be given to you, but you will not have any voting right. Right? You will not have any voting right. Can we go forward? And some of the students ask very interesting questions. I keep on shouting, out of profit, out of profit, out of profit. And the student, what if the company incurs a loss? Think of it, no? I'm shouting at my height of my voice. If the company earns profit, out of that dividend is given. If the company earns profit, first preference is given to preference shareholders. Then the student is asking, what if the company makes a loss? My dear, if the company is earning a loss, will the company give you dividend? Think of it. No, we have been discussing this again and again. Right? If the company is earning a loss, where is the question of dividend? Why do you ask these kind of questions? Right? Think logically. Please think logically. Okay. Now come back to the equity market. Two terms, IPO and FPO. There are two terms, IPO and FPO. What is IPO? Initial public offering. What is FPO? Follow-on public offering. Okay. What is IPO? Initial public offering. FPO, follow-on public offering. What is the concept of IPO and FPO? Let me explain it. Now imagine today, I'll just take a situation to make you understand. Don't take it personal. Don't start criticizing me. Imagine today you will realize that economics is very difficult. I feel polity is also very difficult. Geography is also very difficult. Ultimately, UPSC is difficult. So some of you will decide that, and you will decide rather than spending 1 year, 2 years, 3 years to prepare UPSC, why not? Why not invest money and start a business? Okay, just a hypothetical situation. I'm not recommending that. Hypothetical situation. So let's say two of you will come together, invest money and start a company. And let's say company performs very well. It starts earning profit. Now you are very ambitious. You want to expand operations. You want to open more and more manufacturing facility. You want to enter into other states also, right? You want to expand the scope of a business. So now what you will do, you will decide, let's go public. There's a term, very, very famous. You will decide that let's take the company public. Let's make the company public company. Now, what is the meaning of it? Please tell me, as of now, can I say the ownership of company is within only two people? Yes or no? In this example, as of now, ownership of company is between only two people. Now, what you will do is you will decide that, okay, we do not want to keep the ownership only within two people. We will sell the ownership to the public. We will sell the ownership of the company to the public so that we will generate lot of money. We will sell ownership, collect money and invest and expand the operations of the company. Purchase one more company, set up a new manufacturing facility, acquire two more companies, etc., etc. So now the logic is okay. Why do they call this as going public? Yes or no? Please do let me know. Does it make sense to you why they will call this as going public? Until now, the ownership was only within two people, between two people. But now, ownership will be sold. Ownership of the company will be sold to the public. That is the reason this process is referred to as going public. Company is going public, they will say. Now, let's start. You started the company in 2023, that is this year. And let's say in 2030, you will decide we will go public. Okay, in 2030 we'll decide let's go public, means we will sell ownership of the company, shares of the company, and we will collect the money. Can I say, follow this very carefully, can I say in 2030 you will be issuing shares of the company for the first time ever to the public? Think of it and please do let me know. In 2030 you'll be issuing the shares of the company for the first time ever to the public. Because you are issuing it for the first time ever, it is called as initial public offering. All of you okay with this? Because you are issuing the shares of the company for the first time ever. Until now, it was there only with you. Now, it is issued to the public for the first time. It is called as initial public offering, IPO. Now, once IPO is over, let's say in 2030, IPO is over. This company again will issue shares in 2035. Let's say hypothetically. In 2035, same company will issue shares again in the market. Why? To raise capital, to collect money, to invest more money. That's it. They want to earn more profit. If they want to earn more profit, they will have to spend more. How can they spend more when they don't have money? So sell more shares, collect more money, spend more money, generate more profit. So in 2030, same company which has already conducted IPO will issue shares again in the market. This will be called as FPO. Follow on public offering. Follow on public offering, right? Some of the experts will also refer to this as further public offering or follow on public offering. Now, what if the same company will issue shares again in 2044? Again FPO, correct? If they issue shares again in 2044, FPO. What if they issue shares again in 2058? FPO, follow on public offering. So for the first time when you issue, it is IPO. After that, you can issue shares for the second time, third time, fourth time, fifth time, doesn't matter. It is always FPO. Once IPO is over, any more times you issue, it will be referred to collectively as follow on public offering. Can we go forward now? Right? Can we go forward? Initial public offering. Right? The company will be a listed company. Company will be going public. Now, what do you mean by listed company? Listed company means the shares of the company are available in the stock market. I'll repeat the statement. What do you mean by listed company? The shares of the company are available in the stock market. For example, please tell me, are the shares of Adani company available in stock market? What about Infosys? What about Zomato? Correct. All these companies are listed companies, and the shares of these companies are available in the stock market. Right. So whenever the company will go public, it also means shares of the company are available for trading purposes in the stock market. Such companies are called as listed company. Such companies are referred to as listed companies. These are referred to as listed companies. Okay. FPO means follow on public offering. A listed company again will issue shares in the market for the second time, third time, fourth time, sixth time, etc. Right. So that is the concept of IPO as well as FPO. IPO as well as FPO. Now, do you remember primary market and secondary market? Do you remember the concept of primary market and secondary market? What is a primary market? The instruments are issued. The instruments are issued or instruments are sold from the issuer. Remember this. What is a primary market? Right? Primary market is a market where new instruments, remember that instruments for the first time will enter into the market. That is called as a primary market. For example, can I say IPO is a primary market? Yes or no? Let me know. IPO is a primary market. Initial public offering is a primary market. Right? On the other side, there's a term called a secondary market. What is a secondary market? Let's start. Imagine a company XYZ will conduct IPO. Okay? Imagine a company XYZ will conduct IPO. You will purchase 50 shares of the company. You will purchase 50 shares of the company. This is nothing but primary market. Okay, this is nothing but primary market. Now, after 1 week, after 2 weeks, or after 2 days, you want to sell these shares to somebody else. You want to sell these shares, let's say, to me. Now, simple question to all of you. Simple question to all of you. Can you be referred to as issuer of the shares? Think of it. Will you call yourself as an issuer of the shares? No. You're an investor. Some of you are saying yes. My goodness. My dear, the shares are issued by company XYZ. Issue means, are you the authority which has printed these shares? Let me take it in literal sense now. Are you the ones who is printing and selling these shares? Issuer. Right? No, you are owner of the shares. No doubt, you are the owner of the share, but you are not the issuer. For example, let me make it very, very clear to you. Who is the issuer of G Security? Let me see. Who is the issuer of G Security? Right? Will you say, sir, I am purchasing G Security, I will sell it to you, I will call myself as issuer? No. Issuer of G Security will be government only. You might purchase it, you might sell it. Who is the issuer? Government. In the same way, who is the issuer of these shares? Company XYZ is the issuer. You are the owner. You are selling it again. So, can I simply say, when the instruments are already issued, I repeat, the instruments which are already issued will be sold, will be purchased, etc., that will be called as secondary market. Can we go forward now? I'll repeat it again. The instruments which are already issued, already there in the market, will be purchased, will be sold, in simple terms, will be traded. It is called as secondary market. For example, you have 50 shares of company XYZ. I will purchase the 50 shares from you. Secondary market. I will sell 25 shares out of it to my friend. Secondary market. Right? Best example of secondary market is Bombay Stock Exchange as well as National Stock Exchange. Correct? I'll repeat it. The best example of secondary market is Bombay Stock Exchange as well as National Stock Exchange. That is in BSE as well as NSE. The instruments, the shares which are already issued will be purchased, will be sold. Can we go forward now? Right? Can we go forward? Many of you are asking, sir, where can I find primary market? Where can I find this, etc., etc.? My dear, whenever I use the term primary market, do not imagine a market like vegetable market. Many of you believe that primary market will be like a vegetable market, where the CEO of all the companies will be sitting with shares. You will go and you will purchase from them. No, my dear, everything is done online. Everything is done online only now. And that's the reason I keep on asking you, read newspapers correctly, watch television correctly. Nothing wrong with watching TV, but observe things. Have you not seen in newspaper ads or television or billboards, etc., advertisements given for a company whose shares are supposed to be sold? Let me know. Have you not seen these ads also? Right, where the company will say the offer will open from 5th of September and will close on 8th of September. If you want to subscribe to the shares, please subscribe, etc., etc. Observe, please observe. Right, so do not imagine that primary market is like a vegetable market, where you will go, you will purchase 5 shares of this, 10 shares of that, and you will start negotiating with them. You'll say, right, I'll purchase 2 shares, right, 1 share is equal to 50, give me 2 shares in 80 rupees. No, that kind of market is not there. Everything is done online. Everything is done online. Virtual market. This is a virtual market now. Okay, done. So primary market as well as secondary market. Now, many of you are asking me, so how the prices are determined? My dear, you tell me, do you think the prices of all the shares which are issued, irrespective of the company, will be one and the same. Let me know. Many of you are asking how the price of the share will be determined. My dear, there are so many factors. There are so many factors, internal factors, external factors. How is the company performing, right? What is the demand? What is the order book of the company having? How much is the debt of the company? How much is the profit of the company? Will the company's revenues be affected by Israel Gaza war, etc., etc.? Right? I hope you understand. It's not just one factor that will determine what is the price. There are hundreds of factors that will determine what is the price of the share which are issued in the market. For example, a company, right? Imagine if a company is purchasing lot of raw materials from China, and government of India. I'm just giving you a hypothetical example. A company is purchasing lot of raw materials from China, completely dependent on the import of raw material, and there is a breakdown of trade relation between India and China. Don't you think the price of shares of this company will take a hit? Does it make sense to you or not? Think of it. Please think of it. Right? I'll give you another example. If you're reading newspapers today, if you read newspapers today, Google has announced that it will start making higher end smartphones from India or in India from next year. Now, please tell me if the shares of Google are listed in India. They are not, by the way. If the shares of Google are listed in India because of that announcement, don't you think automatically the share price in the market will increase because of such announcement? So I hope you understand that there are hundreds of factors which will have an influence, which will impact the price of the shares in the market. You cannot simply say only this or that. There are hundreds of factors. Okay, so what is the primary market? The company will issue the shares to the public for the first time, and this is called as going public. And until you go public, the company was privately owned. And in my example that I gave you, the company was owned by only two people, privately owned by two people. Initial public offering as well as follow on public offering will be conducted. Once IPO is done, the shares of these companies are there in the market for trading purposes. And whenever these instruments are traded, that market is called as a secondary market. Okay, and once IPO is conducted, it is called as a listed company. Right? What is a secondary market? We have discussed examples of secondary market in India is a Bombay Stock Exchange as well as National Stock Exchange. Then can we go forward? Can we go forward? Any problem with the primary market, secondary market, shares, preference shares, equity shares, right? What is IPO? What is FPO, etc. In fact, if you want to read, there are a lot of concepts within this. There are a lot of concepts within this. For example, have you heard of short selling? Let me see. Have you heard of short selling? Current affairs. Let me see how many of you heard of short selling. Current affairs. Where was the term short selling there in the current affairs? Related to Adani companies? Yes or no? Related to Adani company. Again, I'll not talk about the political aspect of it, right? Whether they have done wrong, etc., etc. What is short selling? Understand that. What is short selling? You simply understand that. And let's say hypothetically, right now there is a share in the market. There is a share, okay, company share, and the market price of the company share is, let's say, hypothetically 100 rupee. Okay, hypothetically the share is 100 rupee, and let's say you are the owner of the share. You are owner of the share. Okay, now I will borrow the share. Understand this very carefully. I will borrow this share. I will borrow it. Let's say for 5 days, or let's say for 7 days. Short duration. Generally, short selling is done for very short duration. Okay. I will borrow the share, right, from you. I'll borrow the share from you. Now have a look at this. When you borrow the shares, after certain time period, the market prices of the shares will change. Correct? The market prices will change. Market price of the shares will change. Let's say hypothetically, after 2 days or after 3 days, the market price will become 110. Sorry, just a second. Market price will become, just a second, 90 rupees. Market price will become 90 rupees. So what I'll do is I will sell the share. I will sell the share. And array, 1 second. Short selling price is 100. Market price. Okay. Okay, just a second. I made a mistake. I made a mistake. I'll explain to you later. I made a mistake. I'll explain to you later. Don't worry. Right? The market prices will change. The for a fact, market prices will change. And once the market prices will change, you will basically purchase it and give back. Give back. Okay? Give back the instrument. Give back the instrument, thereby making certain gains. Right? I'll explain to you later. Don't worry. Right? So that is a concept of short selling. You will borrow at lower prices. I'm sorry, you will borrow at higher prices, repay it at lower prices. That is basically the concept of short selling. Okay, so thereby when you borrow at right lower prices and make a gain, right, they will make lot of profits on it. Okay, so don't worry. You will borrow it, sell it, and repurchase it and give it back. Okay, anyways, those are asking, explain again. Okay, anyways, I'll explain it. I'll explain it. Right? I just got confused. I'll explain it now. Imagine the market price is 100. Market price is 100. I will borrow it today. I got confused. I only got confused. My mistake. I'll explain it now. You will borrow. I will borrow it from you and sell it in the market. Simple. Sell it in the market. Which means, tell me, how much money did I earn today? Let me know. How much money did I earn today? Can I say I have earned 100 rupees? Correct, I've earned 100 rupees. And please remember, I have borrowed one instrument, one share from you. I have not borrowed 100 rupees. I've borrowed one instrument from you. Okay. After 4 days or after 5 days, let's say the market price of the instrument will fall down to 90 rupees. Step number two. This is step number one. This is step number two. Earlier, I tried to explain it only one step. That was a mistake. Okay, step number two. After 4 days, let's say market price of the share will fall down to 90 rupees. Now, can I say I have 100 rupees? Yes or no? Can I say I have 100 rupees? Out of 100 rupees, I will take 90 rupees, purchase the share, and return the share to you. Return the share to you. Now, please tell me, by by borrowing, selling, and returning the instrument to you, can I say I've made a profit of 10 rupees here? Yes or no? Now it is perfect. Right? Now it is a perfect. Right? By borrowing one instrument, selling it then, and later purchasing when the prices will fall down, I've made a returns a profit of 10 rupees. This concept is called as short selling. Right? This concept is called as short selling. Very, very famous, very famous. And Hindenburg, right? Hindenburg is basically involved in this. Hindenburg is a short seller. Hindenburg is a short seller. Okay, right? So that is basically there in the current affairs. That is the reason. Please be very careful. Now, some of you are asking, what if the price will increase? My dear, if the price will increase, I will incur a loss. Very simple. If the price increases, I will incur a loss. Right? If the price goes down, I will benefit. If the price will go up, I will not benefit. I will incur a loss. And because understand the logic here, it's a market. I hope you understand, it's a market. Risk is already there. And tell me, don't you think Hindenburg, why it is called as a short seller? They have done this. Many of you will be thinking, why does Hindenburg do this? My dear, don't you think Hindenburg introduced a report which was basically affecting a certain position of Adani company? Think of it. Hindenburg was about to release a report in which they had criticized policies of Adani company. Whether it is correct, wrong, again, investigation is happening. You will come to know about that later. I'm not going to be involved in that. But don't you think a company which knows they are going to release a report in which they are basically alleging certain activities are wrong done by Adani company? They knew that the market price of the shares of Adani company will fall down. They knew that, and that is the only reason they will involve in short selling. Otherwise, what will happen is, without knowing how the market price of the shares will move, without knowing that, if you involve in short selling, if you get into short selling, it may simply backfire. Where market price, rather than going down, might start increasing. Rather than going down, might start increasing. That will affect you. You'll have to pay more money then, right? So you will incur losses. So argument is simple, right? In short selling, you will sell first. You will sell first and purchase later. You will sell first and then purchase later. You will sell at a higher price, purchase at a lower price, which is exactly opposite to the normal transaction in the market. Normally, what happens in a stock market? Normally, in a stock market, you will buy low. You will buy low and sell high. Correct? If you are there in the stock market, you will buy low. Buy low means the market price of the share is 90 rupee, and then you will sell it at 100 rupee, thereby making profit. But in the short selling, in case of short selling, you will sell high. You will sell high and then buy low. Understand the difference? Suddenly UPSC can throw you a statement like this. In case of short selling, you will sell high and then buy low. That is the advantage in case of short selling. Right? So these kind of terminologies can be used by UPSC. Please be very, very careful. And short selling is very famous now because of Adani issue. Because of Adani issue. Both of them are same. How? How both are same? You tell me. How both are same, my dear? Sequence is important, right? Sequence is important. What you will do first in a normal case? In a normal case, what will you do first? You will buy first and sell later. In short selling, you will sell first and buy later. Right? Sequence is important here. Right? Don't forget about sequence. Right? So in short selling, exactly opposite to what you do normally in the stock market. That is the concept of short selling. Okay. Right? And please tell me, don't you think short selling, if you know the market price of the shares will fall down, can you make huge amount of money in short selling? Yes or no? For example, Mr. George Soros, many of the assistances, or let's say many of the companies associated with that kind of activity are alleged to be involved in short selling. They are alleged that they are involved in short selling only, and that is the reason they will criticize this. They will introduce a report, right? They will bring a damning report, etc., etc. So I hope you understand logic behind normal transactions in the stock market as well as short selling in the stock market. Okay. Next concept: external commercial borrowing. External commercial borrowing, ECB, external commercial borrowing. Okay. Now, any issue? How do you sell before owning the shares? My dear, did I not explain this? Did I not explain this? I am not owning shares. I am simply borrowing shares from you. That is generally what is done in short selling. In short selling, I don't own shares. I will borrow shares. Right? Listen carefully when I discuss it. Okay. Now, let me go forward. External commercial borrowing, ECB, external commercial borrowing. Now, what is this concept of external commercial borrowing? ECB refers to the debt, debt means loan, the debt that you take from the external market. Whenever you borrow from external market in the form of bonds by issuing bonds or in the form of loans from a bank, etc., this collectively is referred to as external commercial borrowing. The borrowing by issuing bonds, taking loans, either in the form of a domestic currency or in the form of a foreign currency. That is, under ECB, you can borrow in rupees or even in a foreign currency. That is collectively referred as external commercial borrowings. Now, who is allowed to go for ECB? Who is allowed to go for ECB in India? All the companies which are working in sectors where foreign direct investment is allowed. I'll repeat the statement. All the sectors in which companies are there where foreign direct investment is allowed. That is, in any sector where FDI is allowed, the companies in that sector can borrow under the external commercial borrowing. Okay, all the entities which are eligible to receive FDI can go for this kind of a borrowing route. Eligible borrowers can borrow up to 750 million or equivalent per year under external commercial borrowing. But this amount last year, Reserve Bank of India has doubled it to 1.5 billion. 1.5 billion, up to 1.5 billion dollars per annum you can borrow under the route of external commercial borrowing. Under the route of external commercial borrowing. Now, what are the advantages? What are the benefits of going for ECB? What are the benefits? Benefits are, one, rather than being dependent only on the domestic sources, now you can borrow from external sources as well. Is it beneficial for the companies or not? Think of it. Rather than being dependent only on the Indian money, now you can get money from the foreign market also. That will provide you more access. It will give you more choices. More options are available to you. Okay. The rate of interest is also lower in other countries compared to domestic market. In India, the rate of interest could be 7% on loans, 8% on loans. What if you borrow in USA, rate of interest is 4%? Is it not beneficial for you to borrow at lower rate of interest? Of course, yes. It will also help companies to start importing machinery. How? You borrow $100, you will pay $100 and borrow machinery. Now, please think of it whether this is beneficial. I'll explain to you. Please listen carefully. Example one, you will borrow $100 and you will pay $100 to import machinery. This is one. Second example, you will have rupees. You will convert the rupees into dollars, pay dollars, and then import machinery. Please tell me, as a company, which is more beneficial for you, which is more easier for you to do. Don't you think example one is much more easier? Because what if exchange rate is very high in India today? Think of that. What if exchange rate, that is the rupees that you'll have to pay for a dollar, is very high in India today? This will not be providing any benefit, but this will provide benefit for you. So there are various advantages which are associated with external commercial borrowing, ECB, external commercial borrowing. Now, second, right? What are the disadvantages? What are the disadvantages? What are the concerns associated with external commercial borrowings then? First one, if the company will get access to more and more money, don't you think they may not use the resources very efficiently? Yes or no? If the company will get access to more and more resources at cheaper rate of interest like this, they may not be very much efficient in terms of usage of resources. Right? They might use them in much less efficient way. That is one problem. Second problem, if you keep on borrowing from external market, and if the exchange rate keeps on increasing, that is, you borrow today at $1 is equal to 50 rupees, and after 3 years, after 4 years, when you're repaying, what if it is $1 is equal to 70 rupees? Exchange rate risk is very high for you. Of course, you can go for rupee denominated bonds, but again, this is part of it. What if you're borrowed in terms of dollars? Then exchange rate risk will be faced by you. That is also a concern. Third one, Third one, it will increase the dependency on foreign funds. Indian companies will become more and more dependent on foreign money. Right? Don't you think that is against the concept of self-reliance, Atmanirbharata? Right? So argument is you will become more and more dependent on foreign money rather than Indian money. right? So that is one more concern. And finally, more the amount you borrow, don't you think that will put a lot of pressure because you'll have to repay the amount back? Yes or not? More the amount you borrow, it will simply put a pressure on your repayments. Because understand the difference here. You can collect money by issuing shares. You can collect money by issuing bond. But in case of shares, is there repayment of the money? Think of it. Right? In case of shares, these are perpetual in nature. Perpetual means they are simply issued without any maturity period. No repayment. Whereas in case of bond, in case of loan, there is always a repayment. So when you keep on borrowing more and more, repayment pressure on the company will also keep on increasing. And the market will not take this as a positive aspect. They'll be concerned. Investors will be concerned, right? The lenders will be concerned about performance of your company. Okay, so very high borrowings are also viewed negatively in the market because the debt would be very, very high. Repayment pressure will be very high. So these are some of the disadvantages or concerns which are associated with concept of external commercial borrowings. Okay, external commercial borrowings. Done. Okay, next P notes. Next concept is P notes. P notes are also referred to as participatory notes. Listen carefully. I'll start with an example. P notes are also referred to as participatory notes. Now, what is this concept of participatory note? Let me explain. Now, imagine you are an investor who is sitting in USA. Listen carefully. Listen. First, listen. You are an investor who is sitting in USA. Now, do you think you can directly invest in India's stock market? Think of it. Do you think you can simply bring money and directly invest in India's stock market? No. SEBI will never allow that. What SEBI will say is, SEBI means Securities Exchange Board of India. SEBI is the regulator, market regulator. SEBI will ask you, first come to me. SEBI will tell you, first come to me. I will ask you for documents. Submit all the documents. I will seek certain clarifications. Give me all the clarifications. Then I will give you approval. I will give you a license. Now you are allowed to invest in the stock market. You are allowed to invest in the stock market. But you are worried. What is your worry? SEBI might ask a lot of documents. I don't have all the documents. Documentation is very cumbersome, very lengthy process. I don't want to do that. Or else you do not want to disclose your source of money to SEBI. You do not want to give information to SEBI at all. But you want to invest in Indian stock market. You want to invest in India stock market. Is there any option available to you? Is there any other option available to you? Answer is yes. There is one option available to you, which is very famously referred to as participatory notes. Right? There is a concept called as participatory notes. Now, what is this participatory note? I'll write certain points and listen to me very carefully. In India, under SEBI, there are certain investors which are called as institutional investors who are having the permission to invest in the Indian stock market. Institutional investors. What do you mean by an institutional investor? Can I say? Can I say? A mutual fund company. A foreign mutual fund company is an institutional investor. Think of it. Right? A mutual fund company, can I call it as an institutional investor? What about insurance companies? What about insurance companies? Can I call them as institutional investors? So I hope you understand certain foreign institutions. I repeat, certain foreign means not Indian, outside India. Certain foreign institutions are right are having the approval or have got the clearance from SEBI and they're allowed to invest in Indian stock market. And let's say hypothetically, I'm one of them. Is it okay? Hypothetically, I'm also one of them. So let's go back to the story here. Let's go back to the story. You're an investor sitting in USA. I am an institutional investor who has got the approval or the permission from SEBI. I'm also American, but I've got the approval to invest in India stock market. Now, what I will do is, listen carefully, listen carefully. What I will do is, I will issue this instrument to you. I will collect money from you. I repeat, I will issue this instrument to you. I will collect money from you. I will take this money, invest in India's stock market. All of you okay with this example? I will issue this instrument. I will sell the instrument to you. I will collect money from you and I will invest the money in India's stock market. For example, let me take a very simple example. Let's say I will give this instrument to you. Hypothetical, okay? Let's say I will give this instrument to you at right $10. Right, and let's say hypothetically I will collect 500 rupees. In terms of rupees, I've collected 500. I will take this 500. I'll purchase a share of company X. I'll purchase a share of company X. Now, please understand the logic here. Point number one. This instrument that you have purchased, I will call this as a participatory note. Is it okay? This instrument that you have purchased, I will refer to this as participatory note. How do I define participatory note? Can I say participatory notes are instruments? I'll repeat it. Participatory notes are instruments that are needed for the foreign investor to invest in India without getting the approval from SEBI. Yes or no? I'll repeat it again. I'll repeat the definition here again. Right? What is the participatory note? Participatory note is an instrument that is required for the foreign investor to invest in India without having to get any registration done from SEBI. You are investing in India, not directly, but you are investing in India. But how? You have given the money to me. I've given this participatory note to you. I've used the money to invest in India's stock market because I am registered with SEBI already. I'm already registered with the SEBI. Point number one. Point number two, can I say participatory note is an offshore instrument? Think of it. Participatory note is an offshore. Offshore means outside India. Right? Again, you remember the story. If you understand the story, all of these points are very easy to you. It is an offshore instrument. Right? Point number two. Point number three, there is a concept called as derivative. Very interesting, but very technical. Derivative. Now, do not read derivatives in detail for UPSC. That is not required. Let me make it very simple. Let me make it very simple. What is a derivative? Derivatives are financial instruments. Derivatives are financial instruments which will get their value from underlying asset. I will explain to you. Listen carefully. Right? What is a derivative? Right? Basically, it's an instrument. It's an instrument which will derive its value from an underlying asset. From an underlying asset. There are different types of derivatives. Right? Under stock market, they will basically divide the derivatives into four. Right? Swaps, contracts, futures, options. Again, you don't worry about it. Now understand why this is called as a derivative. Follow this very carefully. Follow this very carefully. Once you understand, it's a game for you. You have paid $10 for this instrument, correct? I'll go back to the example. How much money did you pay for this instrument? $10. And I took the $10, converted that into rupees, 500 rupees. I purchased, let's say, share of company X. I purchased a share of company X. Now, can I simply say, the value of this instrument is connected to market price of this share? Think of it and do let me know. Can I say value of this instrument is connected? It is linked to the market price of this share. If the market price will keep on moving up or down, the value of this instrument will also keep on moving up and down. So can I say, now can I say, this instrument will derive its value from the share which I have purchased in Indian stock market. I'll repeat it again. Can I say this instrument will derive its value from the share that I have purchased in India stock market? If the value of the share will keep on moving like this, the value of this instrument will also keep on moving. Can I call this as a derivative instrument? Now tell me, can I call it as a derivative instrument? It doesn't have any independent value. Why these are called as a derivatives? Why these are called as derivatives? This instrument doesn't have any independent value. There is no independent value to this. Its value will be derived from another asset. Whatever is the value of this, it will be derived from another asset. Hence, these are called as derivatives. So now look at the statement. P notes are among the group of investments which are considered to be offshore derivative instruments. All of you are okay with this point? P notes are among the group of investments considered to be offshore derivative instruments, ODIs. Right? So this is a concept of P note. This is the concept of P note. Very famous in India. Lot of investments from the foreign market will come in the form of P note. But having said so, there is also concern related to this. Lot of issues are there. Lot of concern is there regarding this. What is the concern? For example, imagine, I'm not accusing anybody, imagine there is a person in India, X, who has lot of black money. Now, can I say the person X will take the black money, will route it outside, will take the black money outside India. For example, have you heard of money laundering process? Yes or no? Have you heard of money laundering? Why this is called as a money laundering? Please understand. Money laundering means converting black money into white money. Right? Money laundering means converting black money into white money. Laundry. Do you know the term laundry? English term laundry. Laundry means cleaning. Laundry is nothing but cleaning, right? Cleaning of clothes. But we are not cleaning clothes here. We are simply cleaning, right, the black money into white money. That is the reason this is called as right, money laundering process. So what this person who has huge amount of black money will do is through Hawala, he will launder the money outside India, will give it to the friend. Let's say X. I'm sorry. Let's say he will give it to the friend. Let's say Y, who is sitting in USA. Y will purchase right, participatory notes from me, and I will invest this black money from India back into India itself. Right? I will take this particular money from Y. Y has got it from X. X is an Indian citizen who has generated huge amount of black money. So don't you think they are basically laundering money, right, from markets like this in the form of participatory notes? So there is a concern which has been raised saying that money or black money which is there in the market can be used to again route back into the Indian market itself. Right? That will lead to a lot of money laundering, and that is not actually preferable. Done? Right? So that is a concept of a participatory note. Next one is idea of a credit rating. But before that, let me take a break. If you have questions, please do let me know. Otherwise, we'll take a break. Are Indian companies allowed to maintain their bank accounts in US dollar? Yes, some types of accounts are there. But please understand, there is a lot of process involved in that. You will have to give lot of documentation. You will have to tell them why you have these kind of accounts, etc., etc. Okay. Example of money laundering, Shivaji. Okay. If you have the habit of watching movies, in lot of these movies, have you seen how they will use hawala to launder money? And for example, one of the students says, Sir, it is given in Shivaji movie, right? Yes, right, very much correct. In Shivaji movie, yes, they, again, if you have not seen, no problem. Don't panic and say, sir, I have not seen movie. Will I fail UPSC? Absolutely no. Right? Logic is simple, right? They will take the money, use the Hawala system, launder the money, black into white. Okay. Hindenburg term explain. Are Baba, Hindenburg, they are involved in short selling. They will basically publish a report. The report is right, alleging certain illegal activities in a company. Alleging certain illegal activities in a company. Now the market price of the share will fall down. But before that happens, they would have purchased the shares of a company, right, at a higher price. When the market price of the shares will fall down, they would have borrowed, not purchased. They would have borrowed the shares of this company at a higher price. When the market price will fall down, they will sell, right, and they will repay it. Okay, I've explained how the short selling will work out. Okay. So do we need to just read the news articles or make notes from this? My dear, you will have to remember the concepts which are there in the newspapers, right? You will have to understand what is the importance of these articles. Read them and understand and remember them. How to analyze the stocks? Is it portion of UPSC? My dear, don't enter into analyzing stock market. Trust me, don't enter into analyzing stock market. It's not easy. It's not at all easy. And UPSC, you can check last 10 years question paper. UPSC will never ask you analysis of stock market. Because if you can analyze stock market, then I would recommend enter into stock trading. Forget about UPSC. You will make much higher money in the stock trading itself. Right? So again, it's just a joke, by the way. Don't take it personally and say, how can you accuse me? How can you tell me to leave UPSC, etc. No, UPSC will not ask you about a trading of stock market, how candles are formed, what is right, what is the lowest level, what is the highest level, what is a circuit breaker. All of that is of no relevance to UPSC whatsoever. Okay, done. Can we go forward? Any other issues? Any other questions? Greenium means green plus premium. Greenium is green plus premium. If this is a green bond, what is the face value? What is the face value? Face value of the green bond that is given here is 100. I will not sell it at 100. I will sell it at a higher price. It is called as a premium pricing. Right? That is the reason it is called as a greenium. Okay. What is masala bond? Masala bonds are the instruments which are issued outside India. Debt instruments issued outside India, whose value is denominated in rupees. And I don't understand, why do students keep on asking me, define P note? My dear, definition is there in the slide only. Correct. Definition is there in the slide only. Masala bond, did I not give you the definition of masala bond in the slide? Right? I don't understand. Anyways, okay. Okay, so let me stop the discussion here. Let's take a pause now. We'll restart the discussion at 7:13. We'll restart the discussion at 7:13 p.m. Please join back at 7:13 p.m. Okay. Good evening, everyone. Welcome back. Am I audible? Let me know. Am I audible? Can we start? Others? Okay, done. Let's start. Let's start. Okay, so next concept I want to discuss is the idea of a credit rating. Yesterday, right, if you remember correctly and if you have revised it, when I was discussing the idea of a commercial papers, I said not all the companies in India are allowed to issue commercial papers. Only those companies which have got a very good credit rating are allowed to issue commercial papers. Now today, let's try and understand what do you mean by what do you mean by credit rating? What is the importance of it? Let's try and understand. Point number one, credit rating definition. Those who will start typing what is definition, I am defining now. Credit rating refers to the ability or the willingness of a borrower to repay the debt. Is it okay? Credit rating refers to that is the either the alphabet or the combination of alphabet and number. What does it represent? It represents the ability or the willingness of a borrower to repay the debt. Meaning what? Let's say I've issued a bond to you. Your friend is back. I've issued a bond to you. Can I say I have a debt? Yes or no? I've issued a bond to you. Can I say I have a debt of 100 rupee? I will take loan from a bank. Right? Let's say 10 lakh rupees. I'll take a loan from a bank 10 lakh rupees. Can I say I have a debt of 10 lakh rupees? So, what is the ability? What is the capacity or the ability of the borrower? Borrower could be the government, borrower could be even a company to repay the debt that is referred to as credit rating. Now, come to the table here. I'll go back again to the points. Come to the table here. Generally, the credit rating is represented either in the form of alphabets or in the form of a combination of alphabet and number. For example, if you see the first or let's say the second column, first one is this. I'll change the color. First one, second, third, and fourth. So if you see the second column as well as the fourth column, can I say the credit ratings are given in alphabets? Yes or no? Can I say the credit ratings are given in alphabets? Right? That is point number one. And if you see the third column, the credit rating is given as a combination of alphabets and numbers. Now, some of you are asking, what is this Fitch? What is this Standard and Poor? These are companies. Moody's is a name of a company, credit rating company. Fitch is a credit rating company. Standard and Poor is a credit rating company. So these are the credit rating agencies which are very, very famous globally. The three largest credit rating agencies. All the three are from USA. All the three of them are from USA. Now these credit ratings are divided into two parts. I will basically use different colors. I'll use different colors. Please focus here now. The first classification is the red colored combination. Can you see the red color now? I've tried to make a rectangle. I know lines are not straight. Don't say it is not exactly a rectangle. Red color marker I've used. That is one grouping. Second grouping, I will use a blue color marker. This is the second grouping of credit ratings. Now, what is the basic idea? All the credit ratings which are there in the red marker, red rectangle, these ratings are called as investment grade. These ratings are called as investment grade ratings. For example, have a look at it. Triple A, double A, BAA2, BAA3, A2, A3, all these are called as investment grade. And whatever combinations are there in the blue color rectangle, right? Whatever credit ratings are there in the blue color rectangle, all these are called as a junk grade. All these are referred to as junk grade. For example, alphabet D, junk grade. C, junk grade, right? What about a double B, junk grade, right? Or single B, only B, that is also junk grade. What about BA2, right? BA3, BA1, all these are called as junk grade. Now, why this is important? Why should you understand all of it? Why should you understand? Don't by heart the table. Table is not important. What is the importance of it? Very recently, there has been a lot of discussion regarding sovereign credit rating. Very recently, there has been a lot of discussion regarding sovereign credit rating. Now, what do you mean by sovereign credit rating? Can I say whenever you provide a credit rating for the government means whether the government by issuing instrument, whether they will borrow, right? When they borrow, will they pay it back or not? Right? Is there a higher risk, etc. related to government? So when you talk about credit rating for the government, it is called as a sovereign credit rating. And please remember this, in the table you can use these the ratings same way for the companies as well as governments. You can use the same ratings, that is a triple A rating can be given for a bond issued by government also. Triple A rating can be given as a rating for bond issued by a company also. So ratings will remain same. Only thing is when it is applicable to the government, we'll call this a sovereign credit rating. When applicable to, let's say companies, it will simply be used as a credit rating. And point number two, if you look at the table, the highest credit rating, I repeat, the highest credit rating is a triple A, and the lowest credit rating in case of a standard and poor. Lowest credit rating in case of standard and poor and Fitch is a D, and for Moody's, the lowest credit rating is C. It also means as you keep on moving from the top to the bottom of the table, I repeat, as you keep moving from the top to the bottom of the table, the risk associated with the instrument is increasing. Is it okay? The risk associated with the instrument is increasing. In simple terms, imagine there are two instruments. Imagine there are two instruments. One bond has a double A credit rating and another bond has a, let's say, double C credit rating. Would you demand a higher coupon rate for bond 1 or bond 2? Please participate. Would you demand a higher coupon rate for bond 1 or bond 2 when bond 1 has a double A credit rating and bond 2 has a double C credit rating? Right? You should demand a higher coupon rate for bond 2. Some of you are saying bond 1. Why? Why? Please tell me. Right? If you look at the credit ratings, double A is here. Correct? Double A is in the top. Double A is here, whereas a double C is here. Which means, can I say, second bond has a higher risk compared to first bond when you invest in that? Yes or not? Second bond, if you invest in the second bond, it will carry a higher risk compared to investment in the first bond. So will you not demand a higher coupon rate in case of the second bond compared to first bond? Of course, yes. Right. So coupon rate in case of B2 will be greater than B1. Now many of you ask, what is the use of it? Agreed. What is the use of it? My dear, if you are an investor, just by looking at the credit rating, can you make investment decisions in the market? Let me know. Just by looking at credit ratings, will it not assist you in investment decisions in the market? For example, if you are an investor who says, I do not want to take any kind of risk, of course, debt market is for you. And within debt market, you will prefer to invest in a debt securities which will have triple A rating. But please tell me, having triple A rating, does it mean that company will never default in the future? Think of that also. Having triple A rating, does it mean that company will never default in the future? Of course, no. Of course, no. Right? So the credit rating is decided based on certain parameters, such as how much is your profitability, how much is the size of your order book, right? How much of debt you have, etc., etc. But that is not a guarantee that company will never default in the future. They might default. They might simply default even in the future because the revenues of the companies are affected by so many other factors. So I hope you understand the logic behind the idea of a credit rating. Now, in the context of sovereign credit rating, where is India's credit rating? Where does the India's sovereign credit rating actually lie in the table? I'll give you a statement. Listen carefully. It should be very clear to you. India's sovereign credit rating is at the lowest level in the investment grade. I'll repeat the statement. India's sovereign credit rating is the lowest grade, is the lowest level within the investment grade. Now, what is the lowest level within the investment grade for Standard and Poor, Moody's, as well as Fitch? Triple B, right? BAA and triple B. Some of you are saying single B. My dear, single B. Where is single B? Where is investment grade? Investment grade is a red line. Investment grade is red line. And within investment grade, what is the lowest level? Right? Triple B. Triple B, BAA, India's sovereign credit rating is generally this. India's sovereign credit rating is generally this. Triple B, triple B, BAA3. Triple B, and BAA3. The lowest level within the investment grade. Now, let me ask you a simple question. What if the sovereign credit rating of India is further downgraded? What if sovereign credit rating of India is further downgraded? Can I say point number one? It simply means it is more risky. It has become more risky to invest in government of India securities. Point number one. Point number two, as a result of this, government of India now has to offer higher interest rates, higher coupon rates if they want to borrow. Correct? They will have to offer more interest rates if they want to borrow. Now, please think of it. If they will offer more interest rate, let's say next year, if they do not have sufficient amount of money to pay interest, don't you think that will further increase their borrowings? Yes or not? Just think logically. If you take a loan at a higher interest rate, next year, if you do not have sufficient income to pay that interest, you'll have to borrow more. So don't you think fiscal deficit of government of India would be affected by that? And not just that, what will happen to companies' borrowings? If government of India's credit rating is becoming weaker, foreign investors, foreign lenders will look at it and say it simply means there is a danger of investing in India. All of you will agree with me? If you're a USA investor, imagine India's sovereign credit rating will become junk. Right? Based on that data, will you not come to a conclusion it is more risky to invest in India? It is more risky to give loan to Indian companies now. So what will you do? When you will give loans to Indian companies, you will increase interest rate because you're taking a higher risk now. So even the corporate borrowings from external market will be affected because of downgrading in the sovereign credit rating. All of you okay with this? Can we go forward? All of you okay with this? Can we go forward? Is there any country with AAA? Government of USA. Government of USA, very recently, it was there in the newspaper, by the way. Government of USA, their bonds were at AAA. Now they have been downgraded. Check it. They have been downgraded. It was there very, very recently in the newspaper. Okay. So this is the concept of credit rating. And some of you are asking, is credit rating applicable to individuals? My dear, why are you not revising? Did we discuss civil earlier? Let me know. Did we discuss civil earlier? If you remember correctly, I said civil is applicable to individuals. Correct. Tell me if you have not mentioned it. If you have not mentioned it, then it is my mistake. But I'm pretty sure, 100% sure, I would have told civil is applicable to individuals. Right? Whereas the credit rating is applicable to companies. Credit rating is applicable to companies. Credit rating is applicable to government companies. CIBIL is applicable to individuals. Okay, done. So just remember that. Just remember. Now let me go forward. Let me go forward. Concept of mutual funds. Mutual funds sahi hai. Let's discuss what is mutual funds. Now let me start with a very simple example here. Let me start with a very simple example. What is mutual fund? I'll give you definition. Right? Definition is this, by the way. Mutual funds is a type of investment vehicle consisting of portfolio of stocks, bonds, or other securities. But I'm pretty sure half of you would not understand the meaning of the definition. It's a definition. What is a mutual fund? Mutual funds is a type of investment vehicle consisting of portfolio of stocks, bonds, or other instruments. What will you understand by that? Let me explain, then you'll understand the meaning. Point number one, portfolio means collection. Many of you will have a doubt regarding the term portfolio. Portfolio simply means collection. All of you okay with this? Portfolio simply means collection, group, collection. Now, point number two. Let me explain mutual fund here. Point number one. Look at the picture. Is the picture visible to all of you? Tell me, is the picture visible to all of you? Don't buy heart picture. Understand the concept. Understand the concept. Don't buy heart picture. Let's say there are three investors. Investor 1, investor 2, investor 3. 1, 2, and 3. All the three investors are interested to invest in the market. They are interested. But the issue is that they don't know how to invest. And if you do not know how to invest in the market, my recommendation, don't invest. Don't invest directly like this. Why? It is very, very risky. Very, very risky to invest in the stock market or bond market because you do not know how the market operates. For a very simple reason, you do not know how the market operates. And by the time you understand, reading in Hindu newspaper after 2 days, right, the stock market has gone down, your investments would have simply evaporated in the stock market. So again, coming back to the point, there are three investors who want to invest in the stock market or bond market, but they don't know how the market operates. So what they will do is they will approach a company. They will approach a institution, financial institution. Right? The financial institution I'm talking about here is a mutual fund companies. Mutual fund company is a MFC, mutual fund company. Now, what does a mutual fund company do? Let's say hypothetically, the mutual fund company will collect 100 rupee each. I repeat, let's say hypothetically, the mutual fund company will collect 100 rupee each from all the three investors. So can I say, in this example, the mutual fund company has collected funds worth 300 rupees. All of you okay with this? The mutual fund company has collected totally 300 rupees. Anybody has a problem? Now imagine you are one of the investor. You're one of the investor. I will collect 100 rupee from you. I will collect 100 rupee from you and I will give you one instrument. I'll repeat. I will collect 100 rupee from you and I will give you one instrument and I will say this instrument value is 100 rupees. Is it okay? This instrument value is 100 rupees. Now, this instrument in simple terms is nothing but a mutual fund. Follow the arrow marks, you will understand. Just follow the arrow mark. The white color arrows which will go to investor A, B and C are nothing but mutual fund units. Let's say hypothetically for every mutual fund unit will have a value of 100 rupee. So investor 3 will give 100 rupee and get 1 unit of mutual fund. Investor B will give 100 rupee and will get 1 unit of mutual fund. Investor A will give 100 rupee and will also get 1 unit of mutual fund. Point number 2. Now, what will I do? What will I do with this all the 300 rupees? I will take this 100 rupee and let's say hypothetically, I will take this 100 rupee and I will purchase bonds in the market. I will take this 100 rupee and I will purchase bonds in the market. So now tell me, if I collect money from you, you are the investors. If I collect money from you and I will use the money to purchase a debt instruments in the market, can I call these mutual funds as debt mutual funds? Yes or no? Let me know. Please participate. If I collect money from you and I will use the money to purchase the debt instruments in the market, can I call this as a debt mutual fund? On the other side, what if I collect money from you and I will use this money to purchase shares in the market, stocks in the market? I will call this as equity mutual fund. Equity mutual fund, debt mutual fund, equity. Right? General argument is simple, where most of the funds are used for purchasing debt instruments. These are called as a debt, right, or debt mutual funds. On the other side, it is called as equity mutual funds. Now in the market, right, some of you will simply say, sir, I checked ICICI. They are not using debt mutual funds, they are using something else. Right? There are different names for it. Of course, yes, every company will have their own different names. Right? For example, in some of the companies, mutual fund companies, they will ask you, you want to take a higher risk, then I will take 60% of your money, invest in the stock market. Yes or no? Right? You want to take a higher risk, right? Then I'll take 80% of your money, I will invest in the stock market. On the other side, if you say, sir, I do not want to take any risk, I don't want to take any kind of risk, I want to be a very, very safe investor, then the mutual fund company will say, in that case, I would recommend you purchase a debt mutual funds, and specifically in a debt mutual fund where most of the investments have gone into government securities, where most of the money we have invested in government securities. So I hope you understand, from one investor to another investor, preference will be different. How much I want to earn will not be the same as how much you want to earn. How much risk I want to take will not be the same as how much risk you are willing to take. That is a precise reason different types of mutual funds are available, but the logic is simple. Either they are investing in bonds or investing in securities or a combination of both of them. Done? That is the concept of a debt mutual fund and equity mutual fund. Let me go to the next point. Imagine I've taken this 300 rupees and I've purchased one government bond. Follow this very carefully. Imagine I've taken this 300 rupees and I've purchased one government bond. Now, can I simply say this is the asset that will be held by me, which is a mutual fund company? I'll repeat the statement. It is an asset which will be held by me. And who am I? I am a mutual fund company. So, can I call myself as asset management company? Let me know. Can I call myself, that is a mutual fund company, as asset management company, because I am managing the assets? I will purchase shares, those are the assets. I will purchase bonds, I will sell them. So I'm managing asset. I'll call myself as asset management company. Next important point. I've taken 300 rupees, I've purchased one government bond. Please tell me, can the market price of government bond change? Can the market price of government bond change? Today it is 300 rupees. Tomorrow it can become 310. It can become 320. It can also fall to 280 rupees. So market price of the bonds can keep on changing. Can we apply the same logic if I use 300 rupees to purchase a share from the stock market? If I purchase a shares from the stock market, market price of the shares are not constant. They'll keep on changing. Which means, what is the point you need to note here? Which means the value of the assets which are held by the mutual fund company will keep on changing. Is it okay? The value of the assets which are held by the mutual fund companies will keep on changing. It will not be same. You can check it. Why? Every day, at the end of the day, every mutual fund company will publish something called as net asset value. NAV, net asset value. Every day at the end of the day, at the end of this particular day, every mutual fund company, they will publish a value called as net asset value. Now, is it okay if I say net asset value? In short, it is called as NAV. Net asset value or NAV will keep on fluctuating from one day to another day. Yes or no? Will keep on fluctuating. Fluctuating means it can go up or it can come down. There is no guarantee. There is no guarantee. It is dependent on the instruments or the assets which are there in the basket here. So argument is NAV value is not same. It will keep on changing. Now, what is the importance of it? What is the importance of it? Right? You are one of the investor. You are one of the investors. Let's say today, at the end of the day, the NAV value, NAV, the NAV value was 360 rupees. Okay, the NAV value was 360 rupees. You will come to me and you will submit the mutual fund and say you want the money back. You'll simply say, I don't want to keep the mutual fund. I want to give it to you and I'll take it back. I want the money back. Now, see how the calculation is done here. The NAV value is 360. How many mutual funds has been issued by me in this example? Let me know. How many mutual fund units have been issued by me in this example? 3 mutual fund units. Very simple. 3 mutual fund units. Investment was 300, but now the NAV value has become 360 and there are 3 units. So per unit, that is your unit will be worth how much money? Your unit will be worth 120 rupees. But please understand, I will not give you complete 120 rupees. I will impose and collect certain charges. I will impose and collect certain charges, but I will give you certain amount of money. This is how the mutual fund industry or mutual fund units actually work. Now, can I simply say, right, it can be less than 300 also? Please understand, NAV can be less than 300 also. What if NAV becomes 270? What if now becomes a 270? In that case, right, per unit will become 90 rupees. After this, again, I'll impose certain charges and collect from you, and I will return the money to you. So that is the reason. Now watch the mutual fund ads. After the class is over, when you're watching the match, right, Pakistan versus Australia or any other match tomorrow, right, Netherlands versus Sri Lanka, if you're watching that match, mutual fund ads will be given. Correct? Advertisements will be played. And they'll simply say, mutual funds are subject to market risk. Yes or no? Mutual funds are subject to market risk. Please read the offer documents carefully before investing. Why do you think they say that? They are saying that because you might feel by investing in mutual funds, there is no loss. But no, there is no guarantee there. I hope you understand, there is no guarantee. There can be losses also, there can be gains also. But one tip, if you're interested in investing, one tip, again, free of a cost, no charges. Don't blame me if it backfires. If you're investing in mutual funds, always invest in long duration mutual funds. Invest for a longer duration. Do not invest in a shorter duration mutual funds. Reason is that in short duration, markets are generally volatile. Look at long duration, markets generally will have an upward trend. Correct? Yes or no? In short term, always there is a volatility. But in a long term, on an average, market would have moved like this. Let me prove it to you. After the class is over, check what is the gold price in the last 7 days. Check what is the gold price in the last 7 days. There will be a volatility like this. Right? There will be a volatility. But if you look at the gold price for last 10 years, if you check the gold price for last 10 years, you will see a line which is moving, right, slanted but upwards. Slanted but upwards like this, right? That is, if you invest in gold for a longer duration, you will get returns. If you invest in the market for longer duration, you will get returns. Right? So long term always is profitable. Profitable in sense returns are better. Okay, that is the reason if you are seeing the mutual fund ads, they will simply keep on saying, do not invest for short term, invest for long term. For example, have you seen a mutual fund ad where Mr. Sachin Tendulkar will promote mutual funds? Yes or no? A mutual fund ad where Mr. Sachin Tendulkar is promoting mutual funds. And what does he say? He says, मेरा भी पैसा right डूब गया, मेरा भी पैसा right नीचे गिर गया, but you will have to wait. Mutual funds in long terms right will give you returns. Invest for a longer duration. Anyways, that is more of an investment talk. Come back to the discussion. UPSC, this is more than sufficient. Can we go forward? All of you are okay with this idea for mutual fund? And some of you are asking, sir, what is the use of mutual fund? My dear, in mutual funds, you are taking help of an expert to invest in the market. You are not an expert. I hope you understand you are not an expert, or you are an expert but you don't have time. You know how the market behaves, but you are busy with UPSC preparation. Yes or no? Right? You know how the market behaves, but you're busy with UPSC preparation. Right? From morning till evening, you're reading only for UPSC. Then who is going to invest in the stock market? On your behalf, your mutual fund company will invest in the stock market. So I hope you understand. It will provide an opportunity for you to invest. These mutual funds, they will impose charges, but charges are very much affordable, very much affordable. So even if you're a small investor, that's the reason I'm asking you to watch the ads. That's the reason I'm asking you to watch the ads. They'll simply say, monthly 500 you can invest, monthly 1000 rupees invest, right? So even small investments you can make in mutual funds, right? The charges are very much affordable. Experts are managing your funds. All these are the benefits. All these are benefits. And moreover, there is a concept of diversification of portfolio. There's a concept of diversification of portfolio. What do you mean by diversification of portfolio? Diversification means in the market they will say, do not lay all your eggs in a single basket. Do not lay all your eggs in a single basket. Right? That is, do not invest all of your money only in one instrument. Diversify. Diversify means invest in different instruments, different companies, or different instruments. That is called as a diversification. Mutual fund companies will provide you that flexibility of diversification because they will not invest in a single market, they will diversify their instruments. Done? Right? So mutual fund. And now come back to the definition. Let me know, does the definition make sense to you? A mutual fund is a type of investment vehicle which consists of portfolio of stocks, shares, and other instruments or other securities. Mutual funds will give small or individual investors access to diversified, professionally managed portfolio at a very low charge. Mutual funds are divided into several kinds or several categories representing the kinds of securities that they are investing in. Right? Debt mutual fund, right? Or equity mutual fund, or a hybrid mutual fund, etc. etc. Mutual funds companies will also charge a small amount of fees on the investors and will collect these particular fees. Can we go forward now? Can we go forward? Can we go forward? Okay, next concept is exchange traded funds. Very interesting. Before I start, let me show you one example. Let me know. Can everybody see what is there in my hand? Answer to my question. Can everybody see what is there in my hand? It's a packet of gems. I'm pretty sure all of you have eaten it. Don't worry, right? I'm not going to ask you questions on the price, who is manufacturer, etc. Understand the logic. Can I say, if I open this packet, okay, if I open this packet of gems, you will see different colors of gems. You will see certain gems which are orange color, correct? You will see some of them are orange color. You will see some of them are red in color, right? Couple of them will be red in color. You will see, right, some of them in blue color, correct? Now, answer to my question, very simple question. If you go to a shop, will the shopkeeper sell only one blue colored gem or a complete packet to you? Think of it. You go to a shop, you want to purchase. Will the shopkeeper sell only one blue colored gem or a complete packet to you? The shopkeeper will say, I cannot tear, I cannot open the packet. You want to purchase, purchase the complete packet. So can I simply say, in this example, either the complete packet will be sold or right, nothing will be sold. You want to buy, you will have to buy complete packet. You want to sell, you will have to sell complete packet. Now apply the same logic. Apply the same logic to one more packet where, let's say, there is a share of company A, there is a share of company B, and let's say there is a share of company C. Apply the same logic. Don't change anything. Instead of gems, apply the same logic to one more packet, right? A combination where there is a share of company A, company B, and company C. What if I say you can sell the complete packet? This one, I'm talking about this one now. Come to this one, not gems. I'm talking about this lower part. What if I say, if you want to purchase, you will have to purchase the complete packet, which will consist of shares of ABC. Or if you want to sell, you'll have to sell this complete packet where there are shares of company ABC. All of you okay with this concept? This is called as exchange traded fund. This in simple terms is called as exchange traded fund. What is the definition of exchange traded fund? Exchange traded fund is a basket of securities. All of you will understand the meaning of basket of securities now. Let me know. All of you okay with the term basket of securities? Basket means group, right? It's a group of securities. So exchange traded fund, it is a group of securities. If you want to purchase, you will have to purchase the complete group of securities. And if you want to sell, you will have to sell the complete group of securities. You cannot tear open the group here. You cannot tear open just like gems packet. Any problem with this concept? Let me know. Any problem with the concept of ETF, exchange traded fund? It represents a basket. Basket means a group of securities. You will have to purchase the complete basket. You will have to sell the complete basket. It is called as exchange traded funds. ETF. Remember this. Very, very famous now. Please remember the concept of ETF. Right? Though it is very famous, so far UPSC has not asked any question on ETF. But once you understand it, it's very, very easy. It is an exchange traded fund is a basket of securities that can be traded just like a stock, but it is a basket. You will purchase Adani company shares. In the same way, you can purchase this basket, this group of securities. You can sell this group of securities. This concept is called as an exchange traded fund. Now, simple question to you. What if I say market price of company A's share, B's share, and C's share increases? Just think of it. Market price of company A, B, and C's share will increase. Can I say that in that case, ETF price will also increase? Yes, ETF price will also increase. And what if I say ABC's share prices will fall down, ETF prices will also start falling down. So can I say ETF will basically track, the ETF price will basically track what is the market price of individual shares. Now some of you are asking, how is this possible? Who will sell it? There are many institutions, financial institutions, which will purchase the shares of company ABC. Let me give a very simple example. Imagine I'm a company, financial institution. I've purchased shares of A, B, and C. Now, can I package it and sell it to you in the form of ETF? Possible or not? Think of it. I'm an asset management company. I will purchase the shares of ABC. I will package it and I will give it to you as an ETF. Perfectly possible. In fact, I'll give you an example. Have a look at this. Right? There is a Reliance AMC. There is a Reliance AMC, Reliance company, Reliance Asset Management Company. It has issued ETFs by the name of CPSE ETF. CPSE ETF. What they've done? They have taken the shares of 12 central public sector enterprises. CPSE stands for Central Public Sector Enterprise. Now, please tell me what you mean by Central Public Sector Enterprise. What does it mean? Can I simply say it is nothing but a company that is owned majorly by Government of India? Yes or no? Can I say it is nothing but a company that is majorly owned by Government of India? Majorly means more than 51%. Central Public Sector Enterprise. So what Reliance company has done? It has taken the shares of 12 central public sector enterprise, packaged it as an ETF, and has issued this ETF. Now tell me, if you purchase one of these CPSE ETF, can I simply say it means you have invested in the shares of 12 CPSEs? Correct? Yes or no? I'll repeat it. If you purchase one of these CPSE ETF, it simply means you have invested in the shares of 12 CPSEs. If you sell it, you have sold the shares of 12 CPSEs. So yes or no, does it make sense to you? Any problem? Does it make sense to you? Right, so that is the concept of ETF. Very, very famous now. Very, very famous. ETFs are very famous. In fact, under National Stock Exchange, more than 100 ETFs have been listed. More than 100 ETFs. Now, just think of it. Just think of it. If we can do this for shares, can we create ETFs even for bonds? Does it make sense to you or not? If you can do this for shares, where you will club the shares of company ABC, can you do the same thing for even bonds? That is, you will take a bond of company A, bond of company B, bond of company C, package it and sell it as ETF. But I will call it as, think of it, if it is a bond, I will call this as debt ETF. I will refer to this as a debt ETF. And if it is that is a packet is consisting of shares, I will refer to it as equity ETF. I will refer to this as equity ETF, exchange traded fund. Everybody is okay with this? Can we go forward? It's a very simple concept. Once you understand it, it's very simple. Once you understand, it's nothing. It's very, very simple. It's a basket of securities. Basket collection. You will purchase the complete basket or you will sell the basket. You cannot break open the basket like this. With the selling or buying an ETF, a basket of assets are sold or bought. ETFs share prices fluctuate all day as ETFs is bought and sold. ETFs are bought and sold automatically means what? Market prices keep on fluctuating. When ETFs are traded, the prices will also vary, and these offer a diversified portfolio. Think of it, instead of purchasing 3 shares of company A, if you purchase an ETF where you will get 1 share of A, 1 share of B, and 1 share of C, can I call it as a diversified investment? Can I call it as a diversified investment? Diversified means different instruments are there. Not just one type of instrument, different instruments. Your investments are spread. Diversification means your investments are spread across instruments. You're not investing in a narrow instruments or narrow spread. The spread is very large. It is called as a diversification. So ETFs will also help you in basically diversifying your portfolio. And next important point, Government of India is also using a concept of ETF to sell the shares of its own company. I'll repeat the statement. Government of India, right, by basically disinvestment, by conducting disinvestment. What is disinvestment? Selling of ownership. Correct. Disinvestment is nothing but selling of ownership. So don't you think when government of India will disinvest, many financial institutions will purchase the shares of these companies, create ETF, sell it in the market, right? So can I simply say ETF also will help in government of India conducting disinvestment, right? So these are certain important points. There are two equity ETFs that you will have to focus upon. Government related ETFs, that is the ETF where government companies shares are the most important part. That will be one CPSE ETF. Second one is Bharat 22 ETF. What is there in the CPSE ETF? Shares of 12 CPSEs are clubbed together and these are sold in the market. Which is the asset management company? It is Reliance Asset Management Company. And there is one more Bharat 22 ETF. The shares of 22 institutions, 22 companies have been clubbed. ETF has been issued, right, in 2017, and right, basically it is managed by ICICI Prudential Asset Management Company. Then, so these are two types, two types of equity ETFs where government companies are there. Government companies are the shares. In addition to this, let me give you one example of debt ETF, again issued by government. Let me give you one more example of debt ETF issued by government. Right, Bharat Bond ETF, very very famous now. Bharat Bond ETF. Somewhere in 2019 and 2020, government issued Bharat Bond ETFs. Now, what is this Bharat Bond ETF? What is this concept of a Bharat Bond ETF? In the Bharat Bond ETF, we are going to club together the bonds which are issued by the companies owned by government of India. That is in simple terms, central public sector companies. The companies owned by government of India, they have issued bonds in the market. We are going to club together these bonds and we are going to sell them in the market, which is called as Bharat Bond ETF. Bharat Bond ETF. Now, what is the speciality of Bharat Bond ETF? Right now, there are around 5 maturities of Bharat Bond ETF: 2023, 2024, 2030, and 2031. Let me explain this. Please understand this very clearly. Slightly technical, understand this very clearly. Let me take a separate slide and explain it to you. Imagine, imagine there is a central public sector company A, B, and C. Okay, there are three central public sector companies A, B, and C. A has issued a bond in 2020 which has a maturity period of, let's say, 4 years. Which means, can I say the bond will mature in 2024? All of you okay? A has also issued a bond in 2019, and let's say hypothetically it has a maturity period of 12 years, which means it will mature in 2031. Correct? Let's say B has issued a bond in 2022, which has a maturity period of 9 years, which also means it will mature in 2031. C has issued, let's say in 2022, a bond which will have a maturity period of 2 years, which means it will mature in 2024. Now, please look at it very carefully. Can I club? Can I club the bonds issued by company A as well as a company B and call it as ETF 31? ETF 2031. Look at it. Please look at the examples. Don't worry about what is the maturity years. Don't worry how many years they are going to mature. Don't worry. But can I say both are going to mature in the same year? So I will club both of them, call it as ETF 2031, which means if you purchase ETF 31, 2 points. You have purchased a bond of company A as well as company B. Both the bonds will mature in 2031. And can I also club? Can I also club the bonds issued by company A as well as a company B and call it as ETF 2024? Does it make sense to you? Can I call it as ETF 2024? Because both of them are going to mature in 2024. So now tell me ETF 2023. Does it make sense to you? Why it is called as ETF 2023? ETF 2024, ETF 2030, ETF 2031. In fact, ETF 32 is also there now. So why these are called as ETF 2030, 31, 23, 24? I hope it is clear to you, right? I hope it is clear to you. Okay. Any problem with this? Any problem with this? Arey Baba, tell me any problem with this? What if there is maturity is 2020? My dear, if a bond which is maturing in 2029 is there, that will not be included in this bond ETF. Very simple. If there is a bond which is going to mature in 2029, that will not be included in this ETF. Very simple. And if you ask me, sir, why specifically 30, 31? Government of India in 2020 basically announced this. If you want to invest for short duration in bonds of Government of India's owned entities, you can invest in ETF 23 and 24 because one will have a maturity after 3 years and one will have a maturity after 4 years. Correct. But if you're a party, if you're an investor who wants to invest for a longer duration, 10 years, 11 years, then there is an option for 30 as well as 31 available to you. So it all depends on whether you want to invest for a shorter duration or a longer duration. Based on that, we have combinations. So Bharat Bond ETF has a fixed maturity period. Okay. It will invest in high quality triple A rated bonds of public sector companies. Can you look at the point here? Triple A rated, which means the bonds which will have the highest credit rating. The bonds which will have highest credit rating, that will be the target or that will be included in the Bharat Bond ETF. Okay? It will hold the bonds till their maturity, right? And whatever interest you are supposed to earn, it will give only after maturity. Right? In case of bonds, generally annual interest is given, but in case of ETF, annual interest rates are not given. Whatever interest rate you are supposed to get, they will collect it, they will keep it with themselves, they will invest in the market. After the maturity period is over, along with the returns, they will give you the interest. The fund will be managed. The fund will be managed by Edelweiss Mutual Fund Company. Edelweiss Mutual Fund Company, it's a type of a company. In case of India, Edelweiss is a mutual fund company. Okay, right? So the fund will be managed. That is, these assets will be managed by Edelweiss Mutual Fund Company. Right? So this is one more type of a debt ETF in the market. Please be very, very careful. Again, I repeat, there are more than 100 types of ETFs. There are more than 100 types of ETFs. You don't have to read all the 100 types of ETFs. Please remember only the two which have been which are linked to Government of India under equity and one related in debt ETF. More than sufficient. Okay. Now, last concept in the chapter, last concept, corporate bond market. Corporate bond market. Okay, corporate bond market. What are the concerns in the corporate bond market? Because if you remember, I've told you this, I'll repeat it. Corporate bond market in India is not very well developed. Correct? Did I mention this earlier? I will tell you the context also. Corporate bond market in India is not very well developed. What was the context? If you remember, earlier we discussed NABFID. Yes or no? Please tell me. In earlier sessions, we discussed NABFID. And I said one of the ways, one of the methods through which NABFID will collect money or raise capital is by issuing bonds. And in that context, I told you, the bond market, corporate bond market in India is not very well developed. We are promoting. It is not very well developed. Now, the question is why? what has been the issue with corporate bond market? Why it is not very well developed? I'll go point by point. Listen to me very carefully. Listen to me very carefully. You will not get all of these in the newspapers. Even in books also you will not get it. I've taken it from SEBI documents. Let's go point number one. First one, most of the bonds issued in India are issued either by the central government or by the state government. I'll repeat the statement. Most of the debt instruments issued in India are issued either by the central government or by the state government. Hardly around 20 to 25% of the total debt instruments in India are issued by the private sector. They will refer to this as very low penetration of corporate bonds. They'll refer to this as very, very low penetration. Penetration means how much of the market is accounted by the corporate sector bonds. Very, very low percentage. Around 20 to 25% is corporate bonds. Rest of them are state government bonds plus central government bond. Why? What is the reason? Right? Understand this. The investor base is very narrow. I'll go to the previous point. Don't panic. Investor base is very, very narrow. What is the meaning of it? First and foremost, there is a bond market as well as equity market in India. Correct? There is a bond market and equity market. Think logically and tell me, the investors such as you and me, if we want to invest, don't you think most of us will invest in equity market and not in bond market? Point number one, think logically, right? Most of us would prefer to invest in equity market rather than investing in bond market. And those who want to invest in the bond market, tell me frankly, would you want to invest in government bonds or corporate bonds? Think logically and tell me. Would you want to invest? Though some of you will say, no, sir, I want to invest in bond market. Agreed. Even when you want to invest in the bond market, would you prefer to invest in government bonds or corporate bonds? Most of you will prefer government bonds, not corporate bonds. Reason is safety. Reason is security. Government bonds are very, very safe to invest. Corporate bonds are risky. So can I simply say, out of total investors, most of the investors will prefer equity market. Those who want to invest in bond market, most of them will again prefer government bonds. Hence, the investor base who will prefer to invest in corporate bonds is very small. It is very, very small. That is the reason I've used the term narrow. Narrow means very small investor base for corporate bond. Next, secondary market is not liquid. What do you mean by not liquid or illiquid? In case of secondary market, what do you mean by secondary market? The instruments which are already there, instruments which are already issued are traded. Traded means the bonds are bought, bonds are sold. Now, in case of India, most of the trading of instruments is either in the form of government bonds or in the form of, right, let's say shares. I'll repeat the statement. Most of the secondary market transactions, that is buying and selling, is either for government bonds or it is for shares, that is equity market. The demand for corporate bonds in secondary market is very, very less. The demand for corporate bonds in the secondary market is very less. Now you tell me, you as an investor, you know that in the secondary market, investors will purchase shares. Investors will purchase government bonds. Very few investors will purchase corporate bonds. Now you tell me, will you purchase more of a corporate bond or will you purchase more of a government bond or shares? So don't you think because of this, right? Because of this, investors in the market generally would prefer to invest and purchase shares. They would invest and purchase government bonds. They would not prefer to invest and purchase corporate bonds. Because when you purchase shares, you're also concerned about will there be buyers of it in the future. Correct? Yes or no? When you purchase a government bond or when you purchase shares, are you not thinking of the future? What is the you're thinking? I will purchase low, I will sell high. I will purchase low, I will sell high, and I will make profit. That is your thinking. But what if I say, if you purchase corporate bonds, very few investors are interested to purchase it from you. You will not prefer to purchase corporate bonds. You will prefer to purchase government bonds. You prefer to purchase shares because there is a lot of demand for those instruments in the secondary market, right? Illiquid secondary market. Next one, repo operations. Please tell me, under repo as well as reverse repo, you will use securities, you will use instruments. What kind of instruments are used under repo as well as reverse repo? Can I say government bonds? Yes or no? Please go back. RBI, repo as well as reverse repo. When you talk about repo as well as reverse repo, you will use the securities, you will use instruments, right? Collateral, assets. What are the assets you are using? You are using G securities, which means even for repo operations, they prefer G securities. They prefer government bonds, not corporate bonds. Right? That will also have an implication of how much will be the demand for corporate bonds by banking sector only. Next one, diversity. Different types of bonds are not there in Indian market. Right? The different types, right? Variation in the bond market is not there. Different types of bonds are very less available in Indian market. Because if you compare that with USA, you apply the same logic to USA. In USA, you will get many types of bonds, many varieties of bonds. Let me give one example. There is a bond by the name of selfies. How many of you heard of this? Again, I'm talking about bonds. I'm not talking about your camera. There is a bond by the name of selfie bond. Selfie bond. Selfie bonds are very long term bonds. Selfies bonds are very long term bonds, very long term bonds, right? These are generally preferred to be invested by those investors who want returns after 30 years, after 40 years, very long term bonds. So in USA, again, don't buy it, don't waste your time. In USA, there is a lot of variety of different type of bonds which are available. When you have different varieties of bonds, different investors would be automatically attracted. That kind of a variety or diversification is not there in Indian market. Correct? Right? So these are some of the issues or concerns regarding corporate bond market. Now, what are the reforms which have been taken? What kind of reforms have been undertaken by the government as well as RBI? Can I say green bonds, allowing green bonds to be issued, allowing 81 bonds, tier 2 bonds, masala bonds, right? Sovereign gold bonds. This is basically promoting diversification of bonds in India. Yes or no? I'll repeat it again. Right? Green bonds, masala bonds, and all these are very new type of bonds. Very new. For example, if you right, imagine you purchase a book which was printed by, let's say, which was printed in 2005, 2006. You will not see masala bonds in that. You will not see green bonds in that. Why? These are very new types of bonds. So allowing green bonds, masala bonds, 81 bonds, or tier 2 bonds, sovereign gold bonds, it will help us in diversification of the market. Diversification of the market. Based on your requirement, based on your choices, invest, purchase these kind of corporate bonds. That is one. Second one is targeted long-term repo operations. Last point for the day. Okay. Targeted long-term repo operations. TLTRO. Now, what is this targeted long-term repo operations? Let me explain it. Right. Point number one. Targeted long-term repo operations is basically a facility that has been provided by Reserve Bank of India. It has been provided, it's a facility which is provided by Reserve Bank of India. Under this targeted long-term repo operations, RBI will provide loans for 1 to 3 years. For banks, RBI will provide loans for a duration 1 to 3 years. A bank which will take loan under this facility, they will have to invest this money to purchase corporate bonds. Is it okay? I'll repeat it again. Right? The bank which will take a loan under this facility, they will have to use the money to purchase corporate bonds. Not any corporate bond. A corporate bond which will have a investment grade. A corporate bond which will have investment grade. And RBI says, I will charge repo rate. I will charge whatever is a repo, because look at the name itself, you'll understand. Whatever is the repo rate existing in that, right? When I give you loan, whatever is the repo rate, I will charge you that particular repo rate. Now, please tell me, if RBI will give a loan to a bank and ask the bank to purchase only the corporate bonds of investment grade, don't you think that will promote more and more demand for the corporate bonds in the market? Yes or no? Don't you think that will promote more and more demand for corporate bonds in the market? Right? So that is how RBI is trying to promote demand for the corporate bonds within the Indian market. In fact, please understand, couple of more reforms are there, right? Current affairs, couple of more reforms are there. For example, how many of you heard of inclusion of government bonds in global indices? Let me know. It was there in the newspaper in the last month. Last 1 month, it was there in the newspaper. Inclusion of government bonds. Inclusion of government bonds in global indices. Global bond indices. I'll discuss that next week. Don't worry. We'll discuss that not today, but next week. Okay, we'll discuss that also, not today. Okay, let's solve the questions then. Let's solve questions. Repeat the point about repo rate. RBI says take a loan under TLTRO, I will charge you repo rate. The rate of interest charge will be repo rate. Okay, 53% have answered. The Department of Revenue is responsible for the preparation of union budget. Statement is wrong. Why? Department of Economic Affairs. DA, Department of Economic Affairs is responsible, not Department of Revenue. No amount can be withdrawn from the Consolidated Fund of India without authorization of the Parliament of India. Statement is correct. Straightforward. Again, it's basically a question where economic points are there as well as polity points are there. So, second statement is correct. All the disbursements are made from the public account also need the authorization of the Parliament of India? No. In fact, yesterday only we have discussed this. Okay, so 2 is correct. Right option will be option C here. Next question. Okay, 49% have answered correctly. Let's solve it. There has been a persistent deficit budget year after year. Which of the following actions can be taken by the government to reduce the deficit? First one, reduce revenue expenditure. Please tell me, if you reduce revenue expenditure, will the deficit come down in the budget? Yes or no? Yes. Right? The deficit will come down. Second, introduce a new welfare schemes. Exactly opposite to the first one. If government will introduce new welfare schemes, revenue deficit will increase and budget deficit will also increase. Second one is wrong. Rationalizing subsidies. What do you mean by rationalizing subsidies? Ensuring that the welfare, sorry, the benefit, subsidy is nothing but a benefit. Ensuring that the benefit will reach right beneficiary. I hope you understand. What is meaning of rationalization? Ensuring that the benefit will reach right beneficiary. I'll give you one example. You tell me whether does this mean actually rationalization. Government of India earlier used to provide subsidized LPG to all houses in India. I repeat, earlier Government of India used to provide subsidized LPG to all the houses. Now Government of India simply says subsidized LPG will be provided only to poor houses. Only to poor houses. Now if you shift the subsidy like this, from all houses to only poor houses, can I call this as a rationalization of subsidy? Yes or no? Can I refer to this as a rationalization of subsidy? Right. In fact, I'll discuss subsidies. Right. I'll tell you what kind of reforms have been undertaken by the government to reduce subsidy burden. What is this a direct benefit transfer? What is this Janadan Aadhar mobile trinity, etc. We'll understand it later. But rather than providing to all houses, if I target and provide only to poor houses, is it not ensuring that benefits are reaching the right beneficiaries? Because do you think Mr. Anil Ambani requires or Mr. Mukesh Ambani, Mr. Ratan Tata require LPG subsidy? Or for that matter, the richest 100 people in India require LPG subsidy? No, only poor households require LPG subsidy. Right? So rationalization of subsidies will also reduce revenue expenditure and thereby reducing the deficit. So can I say 1 and 3? Right option is option A here. Okay. Next one. Let me explain it. I have not discussed this concept. Let me explain it. Listen carefully. One is called as an interim budget. Second one is called as vote on account. What is interim budget? Next year, Lok Sabha elections will be conducted. All of you know, right? Next year, Lok Sabha elections are there. Now, Lok Sabha elections, let's say hypothetically, are there in month of May. Don't worry about actual date, etc. Let's say it is in the month of May. Okay. And right, government has to announce a budget in February. So there are two options. There are two options for the government. One, the government which is an interim means right basically for a short duration. The interim government right basically will announce a budget just like a normal budget. Just like normal budget. Normal budget means it is going to announce full details of expenditure as well as revenue. Right? Full year's budget, just like a normal budget, they will announce. Or else, there is one more option. For next couple of months, that is, let's say for the next 2 months, government will announce only expenditure. Is it okay? The first option is the interim budget. In interim budget, government will announce the complete as usual, full budget. Whereas in the second case, vote on account, not complete budget, only for certain duration, the expenditure will be announced. That is called as a vote on account. So look at the first statement. Vote on account deals only with the expenditure side of the government budget. Correct? Interim budget does not give the complete financial statement like a full budget. Wrong. interim budget, it can give full details, just like a normal budget. Right, so first statement is correct. Right option for this question will be option A. Option A will be the right one. Okay. Now next one is a descriptive question. Couple of descriptive questions are there. We'll take it up later. Don't worry. Descriptive questions are there. We will solve it. Don't worry. Now, before I wind the class, before I stop the class, if there are any questions, please do let me know. Otherwise, we can wind up the session for the day. As Hindenburg Research made allegations to Adani Group for share price and they were false allegations, can Adani Group file a case against Hindenburg? Defamation case can be filed, but again, that is very complicated. Don't worry, you're talking about law in economics class. Okay. Okay. Any question? What is credit rating concept? Not clear. My dear, credit rating means if you have taken a loan, what is the capacity? Are you in a position to repay the loan or not? That is represented in the form of a credit rating. It's very simple, right? You have taken a loan, right? What is your credit worthiness? And that is basically provided in a form of a alphabet or a number plus alphabet. That's it. Okay. Short selling, explain it again. I will borrow. Do you understand the term borrow? I will borrow a share from you. I will sell it today. Let's say 100 rupees I'll get. After 4 days, the market price of the share will fall down to, let's say, 85 rupees. So I have 100 rupee. Out of 100 rupee, I will use 85 to purchase a share. I will give your share back to you. So I have made a profit. I have earned 15 rupees. That is the concept of right short selling. TLTRO, I'll repeat it again. RBI, imagine I'm RBI, I will give you loan. Either for 1 year or 3 year, I will give you loan. And I will charge you repo rate. Now you can use this loan to purchase corporate bonds in the market. To purchase corporate bonds in the market. That is basically TLTRO. Okay. Why India has a less credit rating? Please understand. All the three rating agencies will have their own methodology. Right? There is no uniform or universal methodology for calculation of credit rating. But according to them, Government of India has borrowed heavily. The debt of Government of India is very high, and the Indian economy is generally exposed to a lot of internal factors as well as external factors. Looking at all of these factors, they say, okay, India's risk for investing in India is slightly higher compared to USA. Hence, I will give a investment grade, but the lowest level. Okay. What is bond market? My goodness, very very bad, very bad. What is bond market? After the whole story is over, you're asking me what is bond market? Bond market is a market where bonds are traded. Right? We started with a debt market definition. I don't know. Okay. Okay. So done. Let me stop the discussion here. Let me stop the discussion. Next week, Monday, we'll continue with the discussion. Okay. Descriptive questions are there. Financial market questions are there. We'll solve it. Right. We will finish the questions. Don't worry. I'll not skip any questions. Okay, so let me stop the discussion today here. Take care. Have a great weekend. But my recommendation, please read the articles. It is for your benefit. If you do not read it, there is absolutely no use of collecting all of them. No use of me sitting, making a compilation and giving it to you. Wastage of your time, wastage of my time. Resources are very precious. Use them efficiently. Done. So let's stop the discussion here. All the best. I'm sorry. Have a great weekend. Not all the best. Have a great weekend. And if you say all the best, then you have a test tomorrow. I can say for that also all the best. So test is there. MCQs are given to you. Descriptive questions are also given to you. Prepare well, attempt those tests, right? Then you will understand to what extent your preparation is going on. Right? So, but my recommendation, keep reading, don't worry, keep reading, right? Don't be disheartened. Even if you're unable to write, it will say take some time for you to practice descriptive answer writing. Please don't worry about it. Okay, done. So take care. See you on Monday again, sharp at 5 p.m. Right? Take care. Good night.